This afternoon we have an eminent speaker of our fraternity, Mr. Vishnu Moorthi, HB, BCom FCA qualified in the year 1990, secured rank in both the inter as well as final examinations. He is a founding partner of Vishnu & Co. LLP. He has been a member of the Committee on Transfer Pricing constituted by the ICAI. He has given lectures in direct taxes, international taxation, VAT, service tax, FERA, FEMA, and GST. Special interest is real estate transactions and transactions restructuring or structuring. He has traveled across the board widely in international assignments. May I call upon Mr. Vishnu Moorthi, please? I would request Chairman Srinivasti to please hand over a bouquet to. Yours. More than 17 years of professional experience in restructuring, amalgamation, mergers, valuation, capital reductions, repatriation, and advisory assignments. He advises top attire listed and real estate companies on complex structuring assignments. Amith is a commerce graduate, has pursued his law graduation, chartered management accountant, and chartered accountancy. He is a rank holder in CA final with a gold medal, and he is also a rank holder in his graduation examination. Amith speaks regularly across various forms on taxes, regulatory and valuation aspects, and has addressed more than 100 seminars. He is also a visiting faculty to IIM Bangalore for corporate programs. We present here both the speakers here today.
I'll go there. I like that one. Good afternoon to everybody. Thank you. In the beginning, let me remember my gurus, Mr. Ramakrishna, whom we lost very recently this year, and of course, Mr. N.C.S. Raghavan, who has been blessing me from the beginning. Both of them were blessing me, and I think thanks to them, I'm here today. At the outset, let me also thank the branch organizers for this great opportunity to be with you all. Of course, I have the company of Amith, who I always love to hear, because he bats like a Azharuddin. Like, you won't know, when he just touches, the ball goes to sixer. So that is how I always consider Amith. And he readily agreed that I should speak during the nap time, which is going to be. And so all the general topics will be taken by me. Then the hot topic of JDA and partnership, and of course the FDI will come, will wake you up, and then he will take over. With that understanding, in fact, Ashok Raghavan, I must also thank Ashok Raghavan, because originally he was to take this slot, and then he said he wants to go abroad, and so then it came to me. Today he said he will be here, but I think morning he covered some of the topics, and not sure whether he will join in the evening. But anyway, the way we also thought is that we will take through the issues what we have taken up for today's discussion. Here and there, we will give you one or two opportunity to take questions, so that nap time, you are able to be awake, get up. And of course, the discussion, you have to leave it to us to stop those questions, because otherwise we may go beyond the time. So we may cut down the questions depending upon our convenience, but kindly pardon that for that, and then we will take up those questions at the end jointly. This is just to keep, some momentum between both of us, otherwise it may become really monotonous. With this background, we will now proceed. So we have divided our whole topic into general issues. Then we have JDA. Then we have JDA again in that individual corporates and all that. Then issues relating partnership taxation. Then we'll go to 9B, 45.4 and FDI. The first topic we picked up is regarding the plotted development, which is the most happening real estate activity in the city for the last 2-3 years, especially after COVID. It picked up a lot. Now, in a typical plotted development, the landowner would have been owning the land for long years. He would have aggregated, he has been holding it. Then he will apply for the we call it as a burfi cutting kind of projects, where the land will be cut into multiple plots, and for that you need to get the approval to lay the roads, then of course other facilities which are required to be provided in a layout as per the regulations. Then he will sell. He has a choice to sell either after completion or during the course of completion, again depending upon the regulations. Earlier we had some 60% you could sell freely. Afterwards you have to take the completion certificate, then you go for again balance sale. There are different regulations in that. Now this land was held by him as an investment. He has not been doing any business. Now he wants to do it as a layout development. Whether the income that would arise out of this plotted development, whether that would be in the character of a capital gain or a business income, has been a question of debate for many years. Many of these got settled at either first level appeal or at assessment level. Very few cases to say that what is the full principle. But I think many of these cases have gone based on the facts. How many years the lands were held, and whether this is a solitary plotted development, and whether even after the development, whether they have sold it in one go, have they continued their activity, because by the time this came for assessment, there was certain also background of the developer or this landowner. Keeping all these minds, these decisions were taken. We have decisions to hold that even a solitary activity can be an adventure in the nature of trade, and therefore it can be a business income. So one view is that it is a business income. Another view is that it is a capital gain. I think largely it will depend upon the facts of the case. If the lands have been held for, let us say, 10-15 years and then it has been developed, we also have decisions to say that it can be a capital gain. Now let's assume if they take the decision as a capital gain, maybe that is what the landowner wants. But if they take it as a business income, now at that point of time, now can the assessing officer say that this entire income is business income? Keeping the fact that aside, that he has been holding the land for last 20 years, can he say this entire income is business income? Answer seems to be that he cannot do that, because he has to recognize the fact that it was held as an investment, and therefore under section 45(2), now the issue is whether the assessing officer is duty bound to consider this investment and convert into a stock in trade, and therefore work out what is the capital gain and then work out what is the business income. Or is it that the landowner himself should have converted into stock in trade and then you offer the business income and capital gain accordingly? So we have decisions to say that even if the assessee has not converted his capital asset into a stock in trade, if the assessing officer were to hold a view that this is a business activity, then he is duty bound to segregate the income between the two heads. So that is one thing. That is also arising from the very section 45(2) also gives that kind of flexibility. It is not that a voluntary action or a requirement that the landowner himself should first convert and then segregate his income. So if there is a decision to consider such income as a business income, there is a need to also segregate the income. Now under 45(2), there is one word which says that when the profits or gains, whenever there is a conversion of a capital asset into a stock in trade, now the capital gain shall be charged to tax in the year in which the stock in trade is sold or otherwise disposed. Now what is the meaning of this otherwise disposed? Now we have seen the extent to which our courts have taken the word otherwise. In the recent decision where they held that under the context of section 45(4), they have said that the revaluation of the assets by the partnership firm and then crediting that revaluation amount to the partner's account itself is adequate to levy tax on the hands of the firm, to say that there is a transfer, there is a fulfillment of all the conditions what are there under section 45(4). I'm not going to take up that topic because Amith will handle that, because that's a topic under 45(4) where he is going to discuss this. Of course, now we have 45(4), a revised version, where things have become all the more clear. But this is a judgment in the context of the earlier 45(4), where there was a provision to say that if there is any distribution of capital assets on the dissolution or otherwise. Now, the word otherwise was interpreted very strangely by the Honorable Supreme Court very recently. On 24th November, we have this decision where they have said that it has got the ability to sweep even in a situation where the lands which are held by the firm, which is not distributed to the partners, where the firm revalued the land and created that revaluation amount to the partner's account. They said this is good enough for the purpose of levy of tax of capital gains from this land which is otherwise not transferred, which is held by the firm continuously. They said that there is it's a code by itself 45(4), and they said there is a capital gain. Now, taking a clue from there, coming back to 45(2), in 45(2) again they use the word, the transfer of a capital, the tax shall be paid as and when the inventory, the stock in trade is sold or otherwise transferred. Now this otherwise transferred becomes important even in a case like this, in a plotted development. Now let us look at it, whether a landowner who has converted his land into stock in trade, now if he gives it on a joint development, whether there is a transfer at that point of time. Now we have been arguing always that, earlier, prior to 45(5)(a) I'm talking, we have, because these cases now can be reopened because there is a window that is available. Before 45(5)(a) came to play, we have been taking a position that we convert the land and into a stock in trade, then give it on a JD. Then we say that giving this stock in trade on a JD is not something which is covered under section 45 at all, because this is a business asset. And the accrual of revenue, insofar as a stock in trade is concerned, it is not governed by section 247. There is no transfer, or the definition of transfer under 247 is not relevant or applicable for the sale of a stock in trade, because the principles of stock in trade, how will you recognize the revenue, is something which is governed by some other provision. So now there can be a scenario where if, let us say, you are not covered by 45(5)(a), there can be a scenario where the assessing officer can look at to see that whether under 45(2), when you converted your capital asset into a stock in trade, and subsequently if you have executed a JDA, is there a tax that can be levied on the entire capital gain on the date of the JDA itself? Because please remember, when you convert an asset into a stock in trade, although the capital gain is accruing, the time for payment is deferred as to the point of sale of the stock in trade. So that is a position we have been taking. Therefore, it is possible that many of these cases where we continue to hold the stock even today, and we are not discharged the capital gains tax because the stock is not yet sold. So this may come for review in the days to come, thanks to this recent decision of the Supreme Court. So coming back to this topic, therefore, is to say that it is possible to argue that a solitary plotted development is a capital gain. It is not a business activity. However, depending upon the facts, assessing officer can take a different position. In that case, then he is duty bound to segregate the income between what is capital gain and what is business income. Okay. Now, one issue here is, or one suggestion here is, I think you had a good session in the morning regarding drafting. Now, one of the structure, we have been doing originally was area sharing arrangement. Thereafter, we slowly also started doing revenue sharing arrangement. I think that's all discussed. Now, both these have their own limitations. Now, the third structure is only you give a license to the other party and then still work out your mechanism of sharing the revenues. You give a license, the landowner gives a license. Now, so I want to take up an issue here. A structure possibility is this landowner who has been holding the land as an investment will enter into another agreement called a license agreement with one of his own group entities, which will be permitted to the plotted development. Entire development activities will be done by another entity of his own family. Then he will still continue to hold the position that I'm holding it as an investment. The entire business activity is segregated, it is assigned to somebody else, and they have done the development. And under the license agreement, now this development entity, it can go and charge the development charges. Landowner will go and sell the plot. Possibly they will do a joint agreements or, depending upon whatever. I think this one structure can help to ensure that your position of capital gains becomes more stronger, and you are not required to pay the tax or compute the tax, or you can then enhance your capital gain. Then you can hold on to this very same plots for long, and then you can sell in as and when you desire. That's what I thought on this topic. Next topic we have taken is regarding transfer under construction, let us say, project. You know that thanks to COVID or otherwise, some of the developers failed to complete their development. Some of them also failed to repay their loans, and thereby we had scenarios where the developers had to assign their entire project to another party. Now, when the project is under development, half of the works are done, is it a land? Is it a building? And therefore, whether section 50C or 43CA would apply. Now, if 43CA is applicable, then you know that the assigner or the transferor has to ensure that the value at which it is transferred cannot be less than the stamp duty value, subject to whatever that, relaxation that was there from time to time. Now, the question is whether an under development project, is it a land or building? We had certain case laws to say that when the materials are put, building is halfway through, it is, as the works that is done is obviously just a lump of materials. It is not building because we cannot use that as such. Neither it is a land because it is no longer a land, because it is already some development has happened. So therefore there are cases to say that this is neither a land nor a building as provided under section 50C or 43CA of the Act. And therefore you are not bound by the guideline value, which is the minimum value at which one has to do the transaction, failing which the differential amount will become as the income, additional income, depending upon whether it's a capital gain or a business income, subject to that 10%, 20% relaxation that they provided. That is one set of decisions. Second, we wish to say that now you know that under the sales tax context, we had the Supreme Court decision where in the case of Larsen and Tubro, where the Supreme Court had a occasion to consider whether the works that are happened, now let us say the customer comes after half a building is done, customer comes and books an apartment. At that time, maybe half of the structure is ready. Now, whether what is done till that date, is it an immutable property or is it something, can you say that it is still a works contract? Supreme Court said that under the concept of works contract, moment a brick is introduced into the project, now that forms part of the immutable property, and therefore whatever was done till the date of that day, it is a immutable property. They then said that only balance work can be the works contract. That was the concept we had under the sales tax from the Supreme Court in the case of L&T. So therefore they said that all works done till the date is a immutable property. So if you go by that, then in the case of a half construction building, it can be said that it is a immutable property. Then you are bound by section 50C or 43CA. So I had an occasion to handle a scenario like this, where what we did, because we clearly saw that the guideline value was coming higher. The value at which it was contracted was lower than the guideline value. So what we then thought, anyway we are paying the stamp duty on the guideline value, so there was a gap. So we introduced a service contracting company from the group, also made them as a joining party to the entire sale deed, where we said that the balance cost, whatever the differential between the guideline value and the contracted value, we said that is the cost to be paid to this contracting company for the completion of the building, and we paid the stamp duty, and we said that the entire consideration is shown in the sale deed. Of course, the beneficiary of that was not the developer alone, it was another party we introduced, to whom then the contract was assigned, and then we subcontracted from there and we completed. So this is what we thought we'll discuss about this under construction property. We'll go to another issue, is sale of SPVs. Okay. Now it is very normal that you will find some of the lands, large parcels of land are purchased and kept in one private limited company for many years, held as asset. We will sign audit fees, 5,000 rupees every year, go and file the annual return. It will be like that. And one day suddenly the value goes from 2 crores to 5 crores to 50 crores. Now you want to sell. That day you realize if you want to sell the land, then you have to pay, the company has to pay the capital gains tax, plus you have to pay the dividend tax if you have to pull out the money from the company. So therefore, and that is one. Second, that many a times when you negotiate, you feel that the purchaser is not willing to pay the price fully because certain benefits that are there in the land which are not immediately available but are available in future. Maybe let us say there is a development plan that is coming up where there is an additional FSI that will be available in the land at any point of time in future. Or maybe there is a metro line that is coming up where there is a potential chance that you get an additional FSI because this land forms part of the metro mouth. All these scenarios where there is a benefit that can come up in the land in future, and therefore you will negotiate with the purchaser saying that here is the base price for the land, and in case in the next 2 years, 3 years, whatever milestone you fix, time period you fix it, if there is any additional benefit that is coming, either after getting the plan approval or after getting certain specific approvals, then I will pay you additional amount. Now these purchasers who is paying you the basic price, he wants to get the entire ownership of the company today itself. Either he wants the ownership of the land or he wants the ownership of the company, but he is still assuring you a future payment which is contingent depending upon the events and the whatever benefits that are crystallized. Now, in such a scenario, so you are divesting your entire ownership, yet you want to get some benefit. So there are structures which are thought of, even Amith is also instrumental. So where it is thought that now as far as the entire equity shares are concerned, it will be transferred to the purchaser. But for your future benefit that is required, how will you ensure that it comes? So then you come up with the option of issuing a OCD by that entity itself. It will issue a OCD for a nominal amount. It could be 1 rupee, 10,000 or 1 lakh. For a nominal amount, a OCD will be issued. Then as and when the trigger point happens, these OCDs will be redeemed at a premium, which may be fixed on day one, which may be variable, contingent, all that. So all those conditionalities will be inbuilt in the very issue of OCD itself, and then depending upon that, it will be matured. So it means that these OCDs then can be matured little later, either at a fixed premium or a contingent premium, variable amounts. Now, let us look at how this whole transaction gets taxed. Originally, you are selling the shares. Entire equity shares will be sold. What are the obligations that we need to ensure is that if the shares are held as a, you have to ensure that Section 50CA is fulfilled, where there is a condition that the consideration for the transfer of equity shares cannot be less than the value of those shares, which is computed as per Rule 11 UA. Now, assuming that you are able to satisfy that, so that entire consideration that is received for the sale of shares will be held as a capital gain. There is no issue. There is no 50CA issue also. So therefore, it's fine. Then comes to the redemption of these OCDs, how that gets taxed. How it gets taxed in the hands of the seller or the person who has subscribed for it, and what happens in the hands of the person who makes the payment or the company who makes the payment. Now the company which is getting the redemption money, these debentures, if they are held for more than 36 months, you can argue that that is a long-term capital gain. If they are less than 36 months, it's a short-term capital gain. There can be one issue where, let us say the debenture redemption premium was fixed on day one. Maybe the department can argue saying that this is an interest component. They can argue, there are judgments also to say that if the amount is fixed, then it cannot be a kind of investment. It is a kind of interest-bearing instrument. So whether it's an interest-bearing instrument or it's a capital gain is a matter of debate. But going by the very fact that these OCDs are issued as an instrument to capture your incremental value that you are entitled upon happening at certain events, there is no money that you have paid. So therefore, it is not a debt that is incurred by the company. It is not a debt that you have given to the company. You have only created this instrument to protect your right. So therefore, there is still an argument to say that whether it is long-term or short-term, that argument remains, but it has to be a capital gain, is one argument. Now coming to the company which has issued this OCD, which finally when it redeems, should they treat it as an interest, the debenture redemption premium, should they treat it as an interest? Or should they treat it as an immovable property because they are after all paying for that whatever incremental benefit that was there on the land which is crystallized? Should they treat it as an interest expenditure? Should they capitalize it to the land? Now look at this scenario. This land was already with the company. Company was the owner of the land. It had paid full consideration. Okay, there was no obligation on the part of the company to do anything more to get that whatever additional benefit. But it is the shareholder of the company who actually exercised his veto power, and he made this company to issue an instrument and made this company to pay the redemption premium, which otherwise it was not liable at all, because it procured this land from third party. It was enjoying the land. If you look at this whole transaction, therefore it appears that this company actually it has gone. You have, as a shareholder, you have exercised your right and created this liability on the company, which otherwise should have been paid by the other purchaser of the shares. So therefore, there is an argument to say that these kind of debenture issue, redemption premiums cannot be an interest. Of course, it can be then, maybe it can be capitalized, but even the allowability of that also can be questioned because that was not a cost or obligation of that company. So that one point remains. Now let us change the structure a bit. Now let us assume that this is not a case where the company was owning the land and then you are selling the shares. Let us assume that the purchaser is buying the land with an offer to you that apart from the basic price, he will also pay you the additional amount. Let us assume this purchaser is a company. And then I say that I want to protect my benefit. I want to ensure that if you don't tomorrow pay, I want to have certain right in the very company itself. Let us say for that, therefore, he goes for a SPV, where I now sell my land to that SPV with the condition that, okay, you pay the basic price today. Now, for the incremental benefit that I am entitled, you issue a OCD to me. This OCD will give me a right that as and when that event happens, you give me that price, whatever is negotiated. And if you fail to pay, I have a right to convert this OCD into equity in the company based on whatever parameters. Okay, so this is an instrument. Now let us look at another instrument where the purchaser itself is issuing. Now this is a purchasing company which actually should have paid the entire consideration for the basic price, also for the incremental price, and that is issuing this OCD. And in that context, it is nothing but an instrument given by that company to secure your additional entitlement. So therefore, when such OCD is redeemed, there is a clear case to argue that it is nothing but the consideration, additional consideration for the very same purchase of that land itself. And therefore, should you have gone and paid additional stamp duty also can be one question. Because you purchased the land, you paid X consideration, now it's an additional consideration in respect of the very same transaction. Therefore, in that case, one should be very careful to see whether you will go and now fix it as an additional sale consideration and pay the stamp duty and register that, or you only redeem that OCD and debit that cost to the land. In my view, in such a scenario, it should be the consideration for the land, and therefore one should pay the stamp duty is what I suggest. We had another scenario also in the very same structure of this, in the same discussion. We can structure these kind of instruments in one more scenario. Let us say you are the owner of the land. You want to develop now a commercial building. Because this structure can also help to save the GST. So let us therefore consider this. Now I am the owner of the land. Okay, I am a company. So I want to develop this into a commercial building. We have no intention to sell it now as units, or we have and there are investors who are willing to take certain portion of the building. Okay, so now if they book it on day one, obviously GST will come. If they purchase it after the completion, there is no GST. And GST, whatever you pay during the construction, cannot be set off against your rental income unless Supreme Court blesses it otherwise, which is pending before the Supreme Court. So therefore, one structure normally thought of is to take this money as a debenture. So you issue OCDs to all the people whoever want to, let us say, own units. So you issue OCDs. What are these OCDs? I collect the money, whatever is negotiated. Then we say that, now let us say we have 1 lakh square feet to be built. We issue the OCDs in such a manner that every person will get one floor or one part of the floor or whatever, depending upon the square feet. Now, so, but that is not said. But OCD is given in such a manner that they can convert their OCD into an equity such that finally all of them own the entity, and thereby they own indirectly they own the complex. So in such a scenario, what are the advantages one will get? Because you can take this money. Now in a OCD, you can give interest to them during the period. You can, if they continue, even after the completion, let us say during the renting period as well, you can continue to pay the interest. Then if they want to transfer their interest, they need not transfer a ownership of the building, they can transfer this OCD itself. So therefore, that is another structure where you issue these OCDs, and then those OCDs have a indirect benefit of ownership. Potentially any day can be converted. Till then, you continue to serve the interest. So that is another structure where the taxation would be different, because this is a case now where the interest what is paid on this OCD would be obviously interest expenditure for the company. The funds are used for the construction of the project. Therefore, there is no difficulty to claim it as an interest, either pre-construction interest or post-construction interest. Of course, those aspects have to be kept in mind. So there is no difficulty. The interest that is paid on those OCDs will always be interest. Of course, there will not be any redemption premium or those kind of conditionalities or various scenarios will not be there. Either it will be converted into definite equity, or it continues to be a OCD, so that you continue to enjoy the interest as an income to the issuer, the subscriber, and the company gets it as a deduction, and therefore you are able to avoid the dividend, and you are able to claim it as an expenditure and keep the entire complex rental income, a taxable income, in the hands of the company at a minimum level. So there the scenarios are different. I just thought I will bring that issue also over here, so that we are able to understand the different aspects of OCDs, where it is self-created, where it is created to assure a future payment, where it is created to as a money-raising activity. You want to say anything on that?
Even JD can structure same way, where we give the OCD.
Yeah. Anyway, he is holding the JDs. He is waiting to bat. First, let me become out. So so we'll now go to the next topic, a little lighter topic. We all know that many times after becoming the owner of the land, we need to pay various payments to improve the title of the land. There can be a scenario where a tenant has been there and he is not vacating, you need to pay compensation to him. There can be a scenario where there has been a fight within the family regarding the ownership, so therefore you need to pay compensation to them. So what is the nature of this compensation? Whether this compensation can be claimed as a deduction? Is it that when I sell subsequently when I sell the asset, whether I should offer the entire consideration and claim it as a deduction? If yes, under what head? Because under section 48, what can be deducted is the cost of acquisition, cost of improvement, and cost of transfer. These are the heads, only these three are permitted. So therefore, when I have an expenditure of this nature, should I do a haircut of the turnover, or should I offer the entire consideration and claim it as an expenditure permitted under these three heads? So here, I think by and large, if the expenses are incurred to improve the title, then they can go as the cost of improvement. Cost of improvement need not be just physical building that has to come up, because your title had an issue and you improved the title. You have ensured that it has become now marketable. Earlier, when the tenant was sitting, you were not able to market it rightly because the purchaser wants the vacant position and you are not able to get the vacant position. Therefore, you have paid compensation to him, and therefore it is a cost of improvement of the title. So that is a topic what we have taken here. Now there are also cases, some of the cases are mostly on the liabilities. Let us say you purchased an asset as a going concern. Now you purchased, a certain liability was there. Let us say there was a loan from the bank. Now you took the decision to pay the money to the bank, and then you did a sale deed. Now let us take an example where, let's say 10 crores is the money paid to the landowner, and you have paid 5 crores to the bank to discharge the loan, and you executed a sale deed for 10 crores. Right or wrong, we'll see. And the guideline value of the land is only 8 crores. Guideline value of the land is 8 crore. Sale deed is done for 10 crores. Before that, you went and paid the bank to ensure that the liability or encumbrance that was there on the land is discharged. Okay. Now, whether the consideration that this seller is required to offer for tax, is it 10 crores or 15 crores? Yeah, so this has been a bone of contention many times that the consideration should it be, owners obviously argued that consideration should be only 10 crores, but the courts have held that it is a gross consideration because even the money that is paid to discharge that liability, which was there as an encumbrance, that is also a part of the consideration. So all the tenancy compensations, even there can be a scenario where, let us say, you had intent and agreement to sell the land, then the other party is not coming forward, or for whatever reason the transaction is not getting completed, and you are now relieving him by paying some money over and above what he has paid. So even that can be called as a amount that is paid to improve the title of the property. So therefore, the money paid to the agreement holders, money paid to the tenants, and similar other payments can also be considered and claimed as a cost of improvement of the property. We'll go to the next topic of transfer of land held by holding company to WS. Here, under section 47, if a holding company transfers any of its assets to a 100% subsidiary, or if subsidiary company transfers any of its assets to holding company, it is not deemed as a transfer under section 47, subject to certain conditions that you should continue to be holding company or subsidiary company for a period of whatever X number of years. Now, so therefore, the very transaction of transferring the land from the holding company to subsidiary company is exempt under 47 because it is not regarded as a transfer. Therefore, is there a requirement to do a TDS under section 194 IA of the Income Tax Act? That is the IA of the Income Tax Act. That is a question that we have posed here. Of course, we have a decision by Supreme Court to say that there cannot be any TDS if there is no income that is embedded. Of course, the section case laws are more on section 195 up to even GE technology, where it is held by Supreme Court that if there is no income, then there is no need to do the TDS, even in the case of a payment to a non-resident. There are similar other decisions are also there, but as far as the domestic decisions are concerned, by and large, the consensus is that the payer is not required to see what is the income embedded therein. If the section calls for a TDS, then you need to do it. Whether there is an income or no, it is the other party to look at it and the assessing officer to look at it. And going by that, and in any case, even sub-registrars would not register such lands. They will not look at whether it's a holding company, subsidiary company. They will look at how it is transferred, is it through a transfer sale deed, and whether it is adequately stamped, and whether there is a TDS provisions. Considering all these aspects, it appears that TDS is something which one need to do, although the transaction is otherwise not taxable under section 47, subject to fulfillment of those conditions. There can be an argument the other way, but I think better to comply is what I would say. Now, we'll go to another topic called deduction of interest on purchase of land. Now, you are purchasing the land, you are borrowed for that purpose. Let's take you are a corporate assessee. Now, this interest that is paid, what is the nature of that expenditure? Is it allowable as an expenditure immediately, or should it be capitalized? If it has to be capitalized, till how long? Now, you having purchased the land, what is the objective of the land? Purpose of purchase is, let us say, is to put up a building. Now, under section 36(1)(3), what it says that any interest paid on the capital borrowed for the purpose of business or profession is allowed. Provision says that, however, if the interest is for the acquisition of a capital asset, such interest shall be capitalized to the till the asset is put to use. Thereafter, it becomes a revenue expenditure. So the concept of section 36(1)(3) is that there should be a capital borrowed for the purpose of business. Then, if the purpose is towards the capital account, you capitalize the interest till the date of asset put to use. If it is a stock in trade, then it is your expenditure of that year. Coming to the ICDS which has been issued, which is now applicable for this transaction, you have a borrowing cost. There again, more or less the concept is the same. So now let us look at the scenario where you have taken the money for purchase of land. Now this land, I bought it, then I have gone for a plan sanction. After 1 year, I got the plan sanction, I am putting the land for use. Now should I stop capitalizing this interest on that day, or should I continue the capitalization till the building is ready? What I bought is land. My loan is for land. Can I claim it as a revenue expenditure moment I put the land into use is one question. There are some decisions to say that it can be, but in my humble view, the very purpose of objective of this land is not to do a cricket field there. It is to do a building. So therefore, the purpose of purchase of the land is to build a building. Till then, this land continues to be a capital asset, because the capital asset becomes complete only when the building also becomes complete. So therefore, one view is to say that it has to be capitalized till the date of the completion. Now let us assume that this land is an inventory. You are buying the land with an intention to develop it and sell it. Now even in that scenario, the inventory, when it is ready for sale, to what extent you have to capitalize? Can you say that I bought the land and I am selling it? Objective is not that, because you bought the land, then you are seeking a plan sanction. You have applied for a plan sanction. So therefore your objective is to continue the land as an inventory even beyond the plan approval. So therefore under ICDS, this becomes, in case of ICDS, it says that in the case of inventories, which are taking more than 12 months time for to bring them to ready for use, ready for sale, then you have to capitalize the interest even during when it is a stock in trade. So therefore, the interest need to be captured or added to the cost of that inventory till the inventory is ready for sale. So therefore, in my view, the interest on loan borrowed for the purpose of purchase of land need to be capitalized till the building is completed or nearly completed to the extent of ICDS, whatever it gives you the flexibility. So that is the point what we have picked up here. So my view is that it should be capitalized till the building is built. Now one question arises here. Let us say, instead of borrowing this money for the purpose of purchase of the land, I purchase the shares of a company. I gave you an example where, let us say there is a company which owns a land, and the landowner is not willing to sell the land to you, because for him then it becomes a business income there or whatever income there, and again dividend tax. He is not willing to do that. So he says, I am only willing to sell you the company. So therefore now, instead of buying the land, you are buying the company which owns the land. Now you are borrowing for that purpose. You are paying interest. Now this interest what you pay on the loan, which has gone for the purchase of the shares, is it allowable? Interest paid on the loan for the purchase of shares, is it an allowable expenditure? Okay, now you are a company, you borrowed this loan, it is sitting in your books, and subsidiary company is the owner of the land. Okay, now let us put this back to section 36(1)(3), which says that the loan interest paid on the borrowers for the purpose of business. Have you purchased this company for the purpose of your business? Answer seems to be yes. Of course, you would not have purchased the very land itself, but you have purchased the shares so that you get that land. Thereafter, you will do the business through your subsidiary company. I think it fits into that broad category of purpose of purchase of shares. Is also a purpose of business. Then comes to the proviso, which says that any interest paid during if it is on a capital account, then it has to be capitalized till the date the asset is put to use. Now what you have paid, what you acquired is shares. So in the case of purchase of shares, till what date can you capitalize the interest? It's ready. Your shares is ready. So there's no question of adding the interest on the value of the investment. You are keeping the shares as investment in your balance sheet. There's no question of adding further interest into that, because interest can be capitalized only till the date the shares are acquired. So therefore, there is no question of capitalization of that interest in the case of a purchase of shares. Obviously, therefore, it becomes a revenue expenditure. Now comes to ICDS. ICDS again, borrowing cost. There it says that if the loan is utilized to bring a capital asset, you capitalize till the date the asset is ready for use. If it is inventory, if it is a elongated inventory, you capitalize it till the date it is completed. The purchase of shares is not fitting into there at all. Then of course it says that it ends with saying that other expenditure, interest expenditure is allowable as per the provisions of the Act. Therefore it comes back to section 36(1)(3), where it says that any interest paid on the capital borrowed for the purpose of business is allowable. Therefore, it appears that now from section 36(1)(3) point of view, this interest paid on this purchase of shares is allowable. Now comes to section 14A, which you have been enjoying all these years, where the argument of the department, section 14A says that if you incur any expenditure in respect of an asset which is where the income derived is exempt, then you cannot take it as a deduction. So 14A can come into picture. But today, again, the dividend that can come in from this investment is subject to tax. So therefore, it is not that the income from this investment is exempt. The income from this investment is potentially taxable. But again, section 57 says that in the case of a dividend income, your interest cannot exceed 20% of the dividend, which is a new amendment that has happened. So you are now in a scenario where you have paid the interest expenditure on the purchase of shares. 36(1)(3) qualifies for deduction. 14A, now there is an argument to say that dividend is taxable, therefore not hit by 14A, but because of the disallowance under section 57 on the dividend taxation, again there can be a potential chance that your interest will be disallowed. Partly. Hot water. Next topic that we have picked up is regarding the hot. Regarding the conversion of agricultural land. Now let us say you have purchased the land or you have inherited the agricultural land. You converted into, let us say residential purpose or commercial purpose in 2010. You are selling it today. Okay. So what is the nature of the asset? It was agricultural land till 2010. In 2010 you converted. Today you are selling a converted land. Now, the question here is, how do you ascertain now in this case, you are entitled for replacement of the fair value as on 1/4/2001. Because it is a immutable property, it is a guideline value which was notified by the government for the purpose of stamp duty. So, you are entitled to replace your historical cost with the guideline value as on 1/4/2001. Now, the question I am putting before you is, now, will you pick up the guideline value of the agricultural land? That was the status as on 1/4/2001 of that land. Will you pick up the guideline value of the converted land? These are the 2 points. Then, if you see the notification which was issued in 2001, there are 2 values always. One is the value in acreage, second is the value in square feet. Now, which value will you pick up? Now, let us say you are selling today the converted land in lump, that is without doing the plotting. So, can you take up the square feet value on 1/4/2001, or should you take the whole acreage value, because there is a difference. There is a difference. Now, if you put the section into play, section 55 says that, at the option of the assessee, insofar as these kind of assets which were acquired prior to 1/4/2001, then you have a choice to replace the guideline value of such asset. Now, whether there are two provisos, whether this such asset is the one which you are selling today, should I take this today's asset it is a converted land, therefore should I take the value of the converted land as on 1/4/2001, although it was not converted then, is the question. What? That's the question. There is a difficulty here to answer it very perfectly. I will make an attempt to answer that the word used is held. Okay, it is not owned. So therefore there is an advantage to say that this converted land was held by him even in 2001. It was held. It was not owned as a converted asset. So therefore there is a case to say that I am selling the converted land, therefore I will take the 1/4/2001 valuation as, of a converted land, one argument. Second, in any case, it is an option that is given to the assessee. Under section 55, if you read, it is an option for you to replace. Now, when you have given an option to me, then give me the option in its full plate. Don't now say, you cut the option to say that, no, you take this or this. No, I am taking, because I am selling converted land, therefore I will pick up the converted land value as on 1/4/2001. We don't have, I think I have not seen any decisions, answering this point, but there is a point that can come up for us in future. Next question issue is regarding section 54F. Under section 54F, you know that if you are selling any asset other than a residential house, then you are entitled to claim deduction under section 54F if the consideration is invested in another residential house. Now, what are the conditions? Condition is that you cannot go for another house. You can buy one more house, but you cannot have a second house. You cannot purchase any second house for the first 2 years from the date of your transfer of the earlier asset. Now the question is, okay, however, if you are already one house owner, you can go for the second house. If you are a owner of 2 houses, you cannot go for third house investment by selling a non-residential house asset, and then investment in a third house is not permitted under 54F. Investment in second house is permitted. Investment in first house is permitted. So now I am looking at, let us say I have sold shares this year. Can I buy 2 houses? I got a large capital gain. I got 50 crores as a capital gain. Can I buy 2 houses? Section 54F permits to invest up to second house. So so therefore there is a potential chance that I can take deduction for 2 houses. Now can I avail that in 1 year? Is the question that I have put before you. Now the language used under section 54F is such that if you are acquiring one house from the capital gain, then for a period of 2 years you cannot acquire. Okay. For a period of 3 years you cannot construct one more house. If you construct or acquire in 2 or 3 years, as the case may be, another house, then the benefit of the first house goes away. So therefore, it is clear that if you have to follow the literal wordings of section 54F, you will not be able to claim deduction in respect of 2 houses under 54F in the very same year. So if you have to achieve that, either you should have gifted your very asset which you have sold to the family members, and then you make everyone to be eligible for one house, or you defer the consideration to next year. So if some part of the sales you put it to next year, then you will be able to fulfill the conditions of 54F. Otherwise, a bare reading of section 54F will not allow you to purchase 2 houses in the very same year from the capital gain. That is the point we thought we'll bring to your notice.
Merge 2 houses into one.
Yeah.
Merge 2 houses into one.
There should be 1 year that we cannot find.
Sorry?
1 year gap we cannot get in a year.
Correct. Yeah, next year you can go. You can still make it because within third year you can put it, last year you can do it. Correct, you can do it. We'll go to next topic, a lighter topic, treatment of TDR. Now, TDR, you know that it is something that you get by virtue of any compulsory acquisition of your asset or under various scenarios for various purposes. Now, question is, when you sell the TDR, whether you have to fulfill the conditions of 50C or 43CA. Let us say TDR is held as an inventory, then whether section 43CA is applicable. You know, under section 43CA, if you are selling any land or building, then your sale value cannot be lesser than the guideline value, subject to that whatever percentage of relaxation that is available. Similarly, under section 50C, if you have transferred any land or building for a consideration lesser than the guideline value or the stamp duty value, then the stamp duty value itself will be treated as a consideration for the purpose of computation of capital gain under section 48 of the Income Tax Act. Now the question is whether these provisions would also apply to the sale of a TDR. That is a point what we have picked up. So if you read the wordings, both 43CA and 50C, it is clear that they have used the word only land or building. And therefore, the TDR, the rights on the land is not available, is not mentioned there. Therefore, one can safely argue that, these sections are not applicable for the purpose of, replacing the consideration than what is transacted between the parties. Next question what we have picked up here is whether now the TDR what you buy, now is it towards the land or is it towards the building? How do you capitalize this TDR? Will you go and add it to the land or will you go and add it to the building? So if you add it to the building, let us say it is a commercial building, tomorrow there is a potential chance that you can claim depreciation on that. That is the point we wanted to bring it out here. Now, for this again, you have to go to the root of the TDR. Now let us say TDR is purchased. Now by virtue of purchasing this TDR, what I get? I get an additional FSI to build on my own land. I would have been eligible for 2.25 FSI. Now let us say I procured some additional TDR. Now my building I can increase from 2.25 to let us say 3.25 times of the land area. Now therefore, this TDR gives me a right to build additional building. Now, question is whether this right remains permanently fastened to the land. Should, let us say after 50 years, this building has to be demolished and it has to be redeveloped. At that point of time, what happens? Whether the FSI what was available originally 50 years ago, will it be available even for redevelopment, or you have to again load TDR then to ensure that the same extent of building you are entitled to build. So depending upon this, now it appears that in some states these TDRs are permanently fastened to the earth such that that land's entitlement of the FSI permanently goes up, and in some scenarios it has a life of only till the building has got a life. Now our answer is that if the TDR gives the life only to the extent of the building life, then it has to be added to the building. If it is a permanent entitlement that this land will get forever, perennially, even for redevelopment, then it is to be added to the land. Interestingly, the guideline that is issued by, CBDT has issued the draft ICDS on the real estate, but they never actually notified it. There they have said that the TDR cost has to be added to the land and not to the building. So they have not segregated this aspect. They have said whatever TDR cost you incur, it has to be added to the land. We'll go to now the leasehold rights. Now you know that KIDB, for example, now gives industrial land on lease basis only. Earlier they used to give on a lease cum sale basis, where it will be initially 10 years of lease, and subject to you having fulfilled the conditions, the completion of the building, then they would execute a sale deed. Thereafter you are the absolute owner of the land perennially. But now, after the change of the policy, all the industrial lands are issued on a long-term lease only. There is either, I think now it up to 90 years or 60 years. So you are entitled to enjoy the land. Thereafter, it goes to the government back. So that is the kind of transaction that they are doing. Now, what is this lease premium what you are paying? Whether this lease premium, is it something which is a rent? Therefore, whether you need to do the TDS under section 194I. Whether this lease rent is also allowable as an expenditure to the other party who has taken this. If it is an expenditure, whether can you claim it on day one? Can you claim it toward the life of the whatever lease period? Or should you capitalize it to the land? This is the point what we have picked up on this topic. Coming to the first point, that now the lump sum rent, what you are paying upfront to get this land. Now we have one CBDT circular also where we have quoted that, where they have said that if you are paying a lump sum rent which is not in the nature of an advance rent, then TDS won't apply, is what they have clarified. That is one position. Coming to the, anyway KIDB is not allowing you to even deduct TDS. They are not allowing. They said if you want to do TDS, you add to your own. They are not, allowing us to deduct the TDS. Now coming to the company which has taken this land on lease, what will you do? How will you treat it? And is it an allowable expenditure? Now, if let us say lease is for a period of 60 years, what is the accounting standards? What is the accounting method will you do? Will you depreciate it? Or will you every year provide for it? Saying that first you treat it as a prepaid rent, let us say. If you say it's a prepaid rent, then every year you need to go on writing it off. Maybe you will get a deduction. If you go and put it as a leasehold land and then you keep it as a, asset, fixed asset, again, because it is getting impaired, after the end of, there is a useful life which is there, you are bound to depreciate it over a period of time. So will you treat it as a depreciation or will you treat it as a revenue expenditure? Coming to the India's, it automatically says that you need to capitalize it and therefore you need to also write it off over a period of time. Then third is, let us say you are acquiring this land. You are already an entity, you are running your factory. You are going for a second factory. Assuming, now in which year will you start claiming this expenditure? Now one view is to say that this entire rent is a revenue expenditure. There are judgments also on that to say that this is a revenue expenditure. Second view is to say that you will claim it over a period of the life. The only way this can be done is because you don't have a depreciation on this leasehold land, because our Appendix 1A of the income tax rules does not provide for this kind of deduction as a depreciation. Therefore, even though you capitalize it and put it to your fixed asset schedule and charge it as a part of the depreciation under the financial statement, when it comes to income tax, maybe you should claim it as a prepaid rent and then apportion it over a period of time, claiming the computation one. Or you treat it as a revenue expenditure on day one, for which you have judgment supports. Now, assuming it is a revenue expenditure, in which year will you claim it? Will you claim it in the year of acquisition? Now, assuming it is a second factory, as I mentioned, you are already running factory. You want to acquire, develop another factory. You have taken the land on lease. Now, this factory will take 3-4 years for you to, bring it to its use. Now, is it a revenue expenditure or it is a deferred revenue expenditure? How will you treat it is another question that will emerge. So, in such a scenario, in my view, you may have to treat it as a revenue expenditure for that factory, and therefore it cannot be a revenue expenditure of the year of incurrence. It becomes a revenue expenditure for that, and then you capitalize in the manner in which you capitalize any other revenue expenditure. So that during the entire construction period, you keep it as a revenue expenditure incurred to bring the factory ready for use, and then you capitalize in any manner in which you capitalize any overhead. this slide talks about the determining the holding periods. What are the difficulties of the holding period? Under Section 242A of the Income Tax Act, we have the definition of short-term asset and then long-term asset. If it is a long-term asset, then we have an advantage of reduced concessional rate of taxes. We have the advantage of reinvestment under Section 54, 54F or EC, whatever. So, therefore, it is very important to decide whether the gain that I am getting from the transfer of a capital asset, is it a short-term or long-term? And this slide picks up some points which are attributable to real estate transactions. Now, we'll take one simple example. Let us say you go and book an apartment. You enter into an agreement to purchase the apartment. You hold it for a period of 3 years. Now the apartment is getting ready and it is about to be delivered to you. Now you don't want to take the sale deed. Instead you want to assign this to somebody else and you make a profit out of that. So whether the agreement what you entered to get this apartment, is it a capital asset? Answer is yes. Are you transferring this capital asset? Answer is yes. Now therefore, the gain, whether it is long term or short term, will depend upon whether you have been holding it for a period of 36 months, because the 24 months for immutable property cannot be applicable for this, because this has not yet attained the characteristics of a immutable property. Therefore, if you have held it for a period of more than 36 months, you can treat it as a long-term capital gain. Now, having said that, now you booked the apartment 3 years back, before it's a long-term asset. You paid 1 lakh rupees on day one. Thereafter, you paid the amounts over a period of time. Now, it is a long-term asset. For the nature of income, it's a long-term capital gain. How will you index this, your cost? Will you index based on the payment?
Yes.
Now, if you see, you are out of 3 years, only 1 lakh rupees you paid, which is more than 36 months. Less than 36 months is major payment. Can you index? Asset is 3 years long term. You paid only 1 lakh more than 36 months. All other payments are made even as recent as 3 months back. Okay, various installment you have paid. Can you index? What is the concept of index? Okay, under Section 48 it says that what is the cost inflation index? It says that you should index from the time you held to the time you sell. Okay, so therefore we have got a decision to say that don't do the indexation based on the payments. Do the indexation from the time you held the asset. Now what will you index? Let us say you are entering into an agreement to pay 1 crore for the flat. Your agreement value is 1 crore, which is therefore more than 36 months. Now you can index that 1 crore itself for 3 years, not these payments. That is the judgment. It's a beautiful judgment, and I mean it is in line with the section also. So because you have now contracted to buy an asset for 1 crore, and you have sold that asset for 1 crore 50. Transaction is that you enter into an agreement to buy a flat for 1 crore, and you have sold it after 3 years for 1 crore 50. So therefore, you should index this very 1 crore itself and not your 1 lakh and then or payments what you have made. So that is a judgment. It is very beneficial judgment. But now let us look at how to apply this in other scenarios also. Now there can be scenarios where, let us say you after 3 years flat is ready, sale deed is done. You have taken the sale deed. Now you feel that you want to sell. You have done the housewarming ceremony, everything you did, but all your friends said, what is this? This is not good, that is not good. You started feeling, now let me vacate from here. Or your neighbor is the worst, okay, among all. You are not aware who will be your neighbor. Now after completion you find that you have got a very good neighbor. So now you want to shift, you want to sell. Now what is the characteristics of this sale? You have taken the sale deed yesterday, now you want to sell. Now, is this a long-term asset or a short-term asset? Short-term. Just now you said if you had sold it, now your wife will slap. You see, yesterday if you had sold it was long-term. Today you are a chartered accountant, you are saying it is short-term. Okay, so you will have a problem. If it was sold before, it is a long term. Now you are saying after sale, it is a short term. But that is how it is. Let us take this little bit more for a JD. I'm sure he will take it for a 6. Now I'm a landowner. I gave the land on a joint development. Okay. I gave this land on a joint development in 2019. We entered into an agreement of allocation of the units between the landowner and me, owner, in 2020. Apartments are completed in 2023 and it is handed over to the landowner. His landowner units are handed over. He is now selling these units in 2023 or 24. Whether these flats are now long-term or short-term. Now, just now you said that when in the other case you said, where I booked the apartment 3 years ago, I took a sale deed, next day I am selling, you are saying short-term. Now I am a landowner, I entered into allocation agreement, it was all under construction. I am also along with one of the purchasers, same purchaser, let us assume it is the same complex. Now the purchaser who purchased it yesterday through a sale deed, but who booked it along with me, same day our agreements happened. There you are saying short term, now landowner you are saying long term. What is this? How will you reconcile? Can we leave the question to him? Okay. Now let us look at it. Now in the case of a developer or a landowner, there is no sale deed that is required to be done, except that a possession is a matter. Now possession is not done through any registered document. Please lend the ears here. We will hear you later. Because we will have a session. Because we are putting some of these propositions, we are open for discussion later, subject to availability of time. What is the time, sir, now? Time how much? Okay, I think I need to quickly close this. So, here in the case of this, there is a landowner there is no document required for the completion and possession. It can be through a letter. So therefore, there is a case to argue that the landowner, got this right on the building on the date of the allocation itself, and therefore it is a long term. We will hear later from Amith. Interest deduction and cost of acquisition, it was a kind of, except that what we are finding here is, let us say now you booked an apartment in the earlier case where you took a home loan. You took the home loan, it is a long-term capital gain, what you are determined, you are selling it after a period of 3 years before taking the possession. Meantime, you have taken the home loan. Whether the interest that is paid on this home loan is allowable as a deduction. Is it a cost of acquisition, cost of improvement, or cost of transfer? Is it allowable? We have a judgment to say that it is allowable. Why it is allowable? Because it is an interest that is incurred during the construction period itself. And therefore, anyway, it was not a revenue expenditure during that period. Therefore, it was not allowable as a deduction under Section 24B of the Income Tax Act. Therefore, it can be claimed as a deduction is one decision we have available, which you have quoted. We will now go to one topic called percentage of completion method. Okay, now how to work out the revenue. If you are a developer, how to work out the revenue under the percentage of completion method. Okay, now we have elaborated here. We have also given an example of computation of percentage of completion method revenue. I am not going into the numbers. I will just, this is prepared in line with the guidance note which is issued in 2012 for a revenue recognition of a developer under a POC method. So we have worked out given the scenario, except that I want you to make one correction in this, the first number 200, kindly change that to some 300, anything above 300. It does not matter in this whole thing. That is how the error remained. So here is a case where we have shown that year one, you have not reached the threshold, both in terms of sale and both in terms of the construction. Therefore, no revenue recognition. Year two, there is a revenue recognition because you have crossed the threshold. Your turnover also has crossed. And then in meantime, what your projected sale has gone up, your projected cost has undergone a change, you are reviewing the projected cost, and therefore how it will impact, what is the revenue you recognize. Year 3, again, it has got incremental things happen both on sales side and expenditure side. We have explained here in column A, showing all the formulas for everything, and therefore it is a matter of just a working. So therefore, kindly go through, and if anybody has questions, always you can call me. We will be happy to answer. Otherwise, it's a matter of simply understanding the guidance note and the entire computation. 1 or 2 points is regarding marketing cost. Now, whether the marketing cost should be claimed as a deduction or should it also be inventorized is a matter. It is very clear that marketing cost cannot be. It is a period cost, therefore it cannot be inventorized. Beyond that, I think these are all numbers. You are more expert than me, and therefore I am skipping this to that extent. Then one small point on, you would have heard of these pre-EMI, subvention schemes what developers offer, where they come up with schemes saying that you book the apartment today, and then, you pay your basic 10%, 15%, 20%. Thereafter, for a period of 3 years, no entire interest on your loan will be paid by me. You have to pay the installment as it applicable. You borrow from so and so bank, he is ready to give you the loan. You pay me, entire pre-EMI interest is mine. Okay, that is the kind of schemes. Now, whether this pre-EMI interest, now this can be operationalized through 2 methods. Either the developer picks up this interest directly by paying to the bank, or it is a scheme where the borrower, the purchaser, he pays to the bank and then it gets reimbursed. Now, in either of these situations, question is it an income, is it an interest, whether there should be TDS on that. We have a Bangalore Tribunal judgment where they said that it is not an income to the purchaser, therefore no TDS is required to be done. And I think that is in the right spirit, is what I feel. Next question is one structuring. Let us say the case what we discussed, where let us say there is a land which is owned by a company and I am acquiring the company. I have acquired the shares of the company. Now I want to dissolve this company and then get the land to myself. Today it is held as a subsidiary company. I purchased the land. Now let us look at a case where the cost of acquisition of the land is 5 crores and I am paying 70 crores consideration for the land. Cost of acquisition is 5 crores. 70 crores is the purchase price. But the seller says that I will not sell the land, I will sell the shares. Now I have bought it. Now what will happen? If I continue this company as my subsidiary company, when I develop this land, what is the cost of acquisition of that land? It is only 5 crores. Because 70 crores I paid for the purchase of shares. Therefore, in the company, the cost is still historical cost of 5 crores. Therefore, my 65 crores will become a business income in the hands of this company if I develop that company, that land in that company itself. Therefore, I am doing in a liquidation. You are holding the shares. You are now relinquishing your right of the shares. Your shares will be extinguished. Instead, you are getting a land. Now, land, the book value of the land is 5 crores. You pay for the share 70 crores. Now you want to ensure that how to convert this share consideration into a land consideration is what we are looking at. Okay, so in the dissolution, now the land comes to you. You are giving up the shares. So section 46 says that you compute the capital gain excluding the accumulated profit. Now in this case, accumulated profit is, let us say, 1 crore. So 1 crore will be treated as a dividend. 69 crores becomes the consideration for the transfer of shares. And what have you procured? Land. So you acquired land, you gave shares. Therefore, now, the capital gain, now what is your capital gain? Your consideration is 69 crores. What is the cost of acquisition of the shares? 70 crores. You paid 70 crores for the purchase of shares. You got 69 crores of worth of land. So therefore your capital gain is a loss of 1 crore. Now, whether you get a stepped up cost of the land, Again, section 55 says that in the case of a liquidation, if a asset is received by the shareholder, now the value that is considered for the purpose of computation of capital gain will be the cost of your land. Now what have we achieved? There was a company which book value was 5 crores, okay, and fair value was 70 crores. You bought the shares of the company. You paid 70 crores for the shares. Now you liquidated, land comes to you. You are able to now replace the 70 crores which you paid for the shares as a cost of the land and claim it as a deduction. Is it good? Okay, so that is what is achieved. Now, as far as the company is concerned, there is no tax at all. So it is you have been able to achieve. Of course, you have to pay the stamp duty here. So you have been able to achieve what you would have achieved through the purchase of land through this dissolution mechanism. We got last 2 slides. I'll just finish. Very small point. Now, agriculture land, which is an agricultural land on the date of sale also, and not liable for capital gains. It is not an agricultural land which is situated within the urban area. Whether you need to disclose this as a part of your computation is a question, simple question. Okay, you have sold agricultural land, it is registered through sale deed. Now it is an agricultural land beyond 8 kilometers limit and or whatever, 8, 6 or 2 or whatever, and therefore it is not liable for capital gain. Should we disclose or no is the question. If you go by the definition of the word agricultural income, it appears that this is not fitting into the definition of agricultural income also, except that there is one explanation which I put on the 4th line there, which reads like this. Explanation 1 states that for the removal of doubts, it is hereby declared that revenue derived from land shall not include and shall be deemed never to have been included any income arising from the transfer of any agricultural land. That word non is wrong. So now the agricultural income definition means in revenue derived from the land is also agriculture income, but this explanation says that from the sale you cannot treat it as a income derived from the land. But then the corollary of that, can it be treated as, but for that is it a revenue derived from the land is the question. In my view, it is a capital receipt, therefore you need not bring it to the computation at all. However, for your future source purposes, if you want to show, then you can always show it and complete it. Last slide is on the section 170. Now, when you take a undertaking through as a sale as a going concern, when you take entire concern, now you become the successor under section 170. Similarly, even under the GST, you become a successor. Therefore, now you are liable for the liabilities of the company also. So therefore, we are just bringing to your notice that in the case of a slump sale, under 170, you become the successor to the company, and therefore, the liability of that company also can fall on our head. That is, there is also a Supreme Court judgment which has been quoted. Friends, with that, the other issues which are, allocated to me, I thought I'll present it in this manner. If there are any questions, both of us will take it up. Sorry, I think I took little extra time. Sorry, Amith, kindly pardon me. I hope, I'm sure he will make it up. He is a very excellent speaker. I request, I wish best to him and all of you to let us enjoy his presentation. Thank you.
We have a tea break also. We'll break for the tea for the next 20 minutes and come back earlier. It is for a half an hour's time it is.
So I'll continue the session from where Vishnu sir left off, starting with GAD taxation. And thanks to ICI, all the committee members for this opportunity for me. So what we'll do is, there are a lot of things to cover. Anyway, I'm pretty clear we'll won't be able to cover everything. At least what we'll try and do is, whatever we are covering, we'll cover well so that at least there is some takeaway instead of sort of rushing through. Hope that's fine. And also any queries you have, we can make it interactive so that you can just post the query there itself, and if it is too lengthy, we can take it offline. Otherwise, you can sort of clarify it then and there itself. Now, I'll spend about a couple of minutes on what is a joint development agreement and what is the concept of a JD, and then dive into the tax aspects so that once the commercials are clear, it is sort of easy to sort of appreciate the tax perspectives. Concept of JD is, generally speaking, if I'm a developer, I will first try scout the land, buy the land, then get approval, do a development on it, either be it a residential or commercial for that matter, and depending on my end stated objective, I'll end up selling. Generally for this, what a developer needs is, he needs a lot of capital, and in India, as you may be aware, banks typically do not fund purchase of land because it's an illiquid asset without any cash flow coming in. So therefore, you're not able to purchase land using from a loan from a bank rather. NBFCs, few of them do fund land purchase using debt funds, but NBFC, if you go anywhere, the whole business model of NBFCs, they'll borrow from bank and they'll lend you. They have to make a net interest margin of 4-5% for the risk, etc. that they're taking. Typically, the borrowing cost will be in today's market about 16% if you want to get land funding. And invariably what happens is, if a developer borrows the money, because there's no cash flow coming for servicing, it will become like a 16% compound interest sort of thing. It becomes very hard to sort of sustain and do the development. So therefore, this is more, JD as a concept has come in, which is more like a win-win sort of a thing. In JD, what essentially happens is, the landowner hands over the possession or license or whatever nuance around the land to the developer. Developer now doesn't need to invest for the purchase of land. However, he just needs to put the money for the development of the land. Effectively, then what happens is, the turnaround time or the holding cost for the developer is very less, because all that he needs to do is fund the construction. And also at the same time, there has to be some skin in the game for the developer, because what happens is, simply if I sign a JD without any deposit, landowner will have to sit waiting for something to happen. So therefore, you have a concept of refundable or non-refundable deposit, what we typically call as goodwill. So in this sort of a scenario, what ends up happening is, land is supplied by the landowner. Now then the developer sort of brings in his enterprise, development capability, builds a building or plotted or any such property. It can either be sold, leased, whatever. That is the nuances around whether it's commercial or residential, area share, all of it will come to. Now from a landowner standpoint, if you look at it, why will anybody want to do this? Now, if you look at it from a landowner, if I am a landowner, say if I sell the land, I may get only like say 5 crores per acre. But if I enter into your JD with a good developer, I may end up realizing about 8 crore, 10 crore or even higher, depending on the strength of the brand. And that way it becomes more like a win-win situation for both, assuming everything goes well. And there are many instances of failed JDs where what the developers have done is taken mortgage on the property, taken the money and siphoned it off elsewhere. Now land is taken over by the banker concerned, or a lender for that matter. Now that are all the sad stories. If we leave aside, fundamentally the crux is, it's a win-win sort of a thing for both. Landowner gets more money. Depending on the structure, I don't need to pay tax today, I get to defer the tax. So therefore there's a timing or present value of money on account of taxes payment also involved. And primarily from a developer standpoint, he otherwise doesn't have any business to do. Now he has access to land to do the development. Okay, with this broad background, what we've done here is split the taxation of joint development agreement between two categories of people. One is non-individual, non-HUF. Other category is individual HUF, because of a very specific section that is there. And also, just to make this JD work, what are the typical facets or ingredients that go into a JD? Typically speaking, landowner hands over the possession of the land to the developer so that the developer can enter and do the construction. And this handover of possession can be two ways. One is an absolute handover of possession through a power of attorney, etc. Other way the landowner hands over the possession is through a license. What I mean by license is, developer has a limited license to enter the property, do the construction as agreed in the agreement. So therefore the ownership or possession is 9/10 of ownership. That is not moving from landowner to the developer. That is quite critical looking at the taxation aspect. I'm just getting this first bit as possession versus license, so to say. Second aspect would be what, typically speaking, developer will want to take construction finance for the project. Construction finance has to come in from a bank, and without mortgaging of the property, you won't be able to raise the money. So therefore, there has to be a mortgage also that is created. In market, there are different aspects there. Generally, rule of thumb is only the landowner, put it differently, the developer area is mortgaged to the bank. Landowner area is typically not mortgaged. Whereas if the comfort between them is good, etc., they may end up mortgaging in it in entirety. That again depends on the commercial constraints. So the second facet is, from a tax standpoint, whether the mortgage rights are given or not. Apart from this, it also comes down to a power of attorney that is given from the landowner to the developer. Why a power of attorney is given is, say developer in good faith does all the construction. Landowner tomorrow wakes up and says, get lost, I'm not going to cooperate with you. Building is standing, land is belonging to the landowner, developer cannot take away the building and go. So therefore, they also come with this concept of power of attorney, where the developer is given certain rights, including rights of selling the property, managing, getting the, development plan approval, all of it. So those things also can be done. Srinivas. Okay, so with this background, I'll just move to the essence or the basic constructs of a joint development agreement, and then move to the tax parts of it. So here, the landowner is non-individual, non-HUF. He enters into an area share joint development agreement. There are different facets for revenue share. I'll come to it later. I put a specific case for that. And the key terms are something like this. Here of handing over of the land possession is, say, year 1. Landowner share is 40%, developer share is 60%. Then you got construction timeline, completion timeline is, say, 4 years. Then there is a refundable deposit and non-refundable deposit. At the core of a joint development, if you see, if it's a 40-60 joint development, where 40 belongs to landowner and 60 belongs to developer in terms of the constructed area. Realistically, if you see, or at the core of it, what is essentially happening is 60% of the land is being given as consideration or being transferred to the developer. Developer in turn is discharging the consideration for construction of this particular property through, or put it differently, constructing 40% of the area belonging to the landowner. Clear? It's like a swap essentially, or a barter. From a landowner perspective, he sells the land. And what he's getting in return is construction service on the area of land he's going to retain. And effectively, like if I can give an example in case of an apartment for that matter, say if it's an area share apartment and say if 100 apartments are built, 60 apartments will belong to the developer, and he'll also be entitled to 60% of the underlying UDS, undivided share in the land. Underlying land may he'll get the UDS. Then from a landowner perspective, he will have 40 of land he already owned, because only 60 he has sold. And there is a building standing to the extent of 40% of the area, which the developer has constructed and delivered to the landowner. This is the broad concept. Now from a tax standpoint, if you look at it, like looking at it logically, what is the transaction that is happening? Simply put, here I sold 60% of my land, which has to be my cost of acquisition from a capital gain tax computation standpoint. In return, what did I get? I got consideration in terms of construction service from the developer. It is as simple as that, but unfortunately it's not going to end there. There are a lot of facets in terms of timing, valuation, all of it. But at the crux of it, it is a swap of land to construction. Okay? And also there is this refundable deposit and non-refundable deposit. What it means is it's more like a security deposit. Non-refundable is not required to be paid back by the landowner back to the developer, as the name suggests. So that is like a goodwill or a sign-on fees. If something goes wrong, that money will never be refunded. Then also you have got a concept of refundable deposit, which should be typically repaid on completion of the project. If it is an apartment sort of a project, then the area is sold by the developer. He retains his portion of security deposit and pays back the balance amount to the developer. I'll not get into those aspects. If you look at it from a consideration standpoint, between refundable and non-refundable, what looks like consideration? Refundable or non-refundable? Non-refundable, because refundable you anyway need to pay back. What income tax generally doesn't tax is present value of money or notional value of money. Put it differently, today I got refundable deposit of say 5 crore in this example. I pay back after 6 years. If I do a present value of 6th year 5 crore, it may be only 1 crore rupees. There is no concept of taxing this delta of 4 crore, saying that this is a notional interest that you earn out of this money over the period of time. Simply put, it is never taxed while you got this money as a refundable deposit. That's a broad construct. Now, from a tax perspective, what are all the points you need to notice? Tax implications broadly I walked through. Quantification will come to, because there's also the section 50D that's applicable. Then also, if you give up irrevocable power of attorney, what happens? And position in case of revenue share, what is the situation there? And also, what is the consequence of an unregistered JD? And also withholding tax implications on area movement or any payments between them. These are the aspects we're going to cover. And one more point I wanted to highlight here is where the asset is held as capital gains, the transfer definition is really critical, which is this section 53A of TOPA, which is in part performance. And if you look at the genesis of why this section came is, people earlier, to avoid capital gain or whatever, even payment of stamp duty, used to pay most of the money as advance, like 90-95% sort of thing, take possession of the property, also typically take a power of attorney on the property. And with all this, it is as good as ownership, because whenever I want to register the property in my name, I have a power of attorney. I'll just go to the sub-register and convey the property to me. By doing this, what effectively was happening is government was not getting stamp duty, because say I'm a power of attorney holder, I want to onward sell. Ultimately, I can simply sell it to a third party where one layer of stamp duty was getting mitigated. So then they brought in this 53A to plug the stamp duty matter. From there, income tax also has picked up, whether part performance is transfer within the meaning of 2(47) of the Income Tax Act. And all the taxation that you see around JD will be surrounding whether it's a part performance, whether possession is given over, constructive possession, all of it. So this becomes really critical. And many cases will look very identical, but the end outcome in terms of the judgment would be very different. When there is a Supreme Court decision in Shasis Mills, they have told that JD, entering into JD is not a transfer. They have not gotten into whether possession is being handed over or not, because they have not gotten into that basis that they have just told that it's a license. But if you look at the like all the facts there, maybe if there was a right of mortgage given to the developer, it may be a transfer. So those sort of things. And many cases it will be just confusing. We have put 3 views and there will be case law for all 3. So 33% will always be right. So there are 2 points of view in terms of JD taxation for non-individual, non-HUF. First view is year of execution of joint development agreement and handing over of the possession should be regarded as transfer. As I mentioned, where you're doing a power of attorney, where you're doing a registered joint development agreement, and also you would have typically given the right to mortgage. If you've done like all these 3 aspects, typically it was required in case of a joint development, then the tax will come upfront at the time of execution of the joint development. This is one view. There are contra view also, we'll talk view 2 in a couple of minutes. Now again here, as I mentioned, there's a transfer under 53A or part performance, therefore it is liable to tax. Now the question comes is, how can somebody pay tax? Because one is, I have not got any consideration, I've just signed the particular deed. Why am I getting penalized? Unfortunately, that's the way it is. Once you have entered or met with all these conditions, I need to pay tax. The question that would come is, how do I break this? One is, I don't hand over the possession, or I don't give the right of mortgage, or I do not register the JD itself. These are the ways to sort of come out of it, where I can defer the tax to a later date. But problem is, commercially, these aspects won't be feasible. As I mentioned, bank won't give you lending unless all these aspects are put in place. And without lending, the project won't start. And if project is not starting, then don't enter into JD to start with. It'll come down to that. However, like if it's a smaller properties, like say many cases what happens is it's a 40-60 property or 50-80 property one has got. Developer will come and say that I'll build 4 flats, you keep 2, I'll keep 2. In those sort of cases, it need not be registered properties, etc. So JD may not be registered, you may not raise debt, all of it. But I'm talking of a scenario where the companies are doing fairly large joint development. What is the position that will apply? And there's a Karnataka High Court decision on this particular thing in TK Dayalu. We referred all the case laws. Basis that once you have handed over the possession, tax will come. Now comes the question of what is the amount that is liable to tax. It's a transfer, no doubt. As per 50D, what it says is whatever is the fair value of the land I've given up, that should be the amount liable to tax. Meaning to say, in this 60-40 example, I gave up my 60% of the land, and the guideline value of the 60% of the land was, say, 6 crore rupees, for instance. 6 crore minus my historical cost of acquisition, subject to indexation, whatever is there, I get that particular thing. Say 1 crore is my cost, I need to pay tax on 5 crore. Clear? This view is a simpliciter view, because many cases what happens is the cost of construction, if you notice, that is the actual consideration I'm getting. Cost of construction is more than 6 crore. Say construction cost, because it's a high spec property or whatever, if the construction cost is say 10 crore, there are case laws which have held that I need to take higher of the two. But again, as I mentioned, it is fact specific, what has gone in, etc. All of it will sort of determine. And again, construction cost, even Sarah has got few decisions, Vishnu sir was saying, where construction cost may come to 10 crore, the argument is that 10 crore will be incurred over a period of 5 years. It is not going to be incurred today, therefore I need to take the present value of it. Present value, if I take, it may even come down to 6 crore, and 50 days specific saying that fair value, therefore it should end at that particular amount. But there are a lot of case laws which have held that cost of construction also needs to be considered. Invariably it will become guideline value of 60% of the area I have given up, or cost of construction of the 40% of the area that I am getting. Higher of the two, I need to pay tax. Fairly clear? And also there are few other decisions. What has happened is I've signed JD 5 years before. Developer has vanished and he has not done any work. And in during assessment, like they have conducted a survey and figured that no work has happened. Those sort of cases are also there where they have told that okay, no tax is payable because the performance of contract has not occurred. Again, it depends, like fact specific, I would say. Okay, with this, I'll move. Covered this bit also, like, and also for computing capital gain, it will be 60% of cost of land or index cost, as I mentioned, that's your cost. Your full value consideration we discussed, delta whatever is there, you pay tax. Okay. Position 2 or view 2 is entering into JD itself will not trigger tax. Much rather tax is payable on handover depending on the position, etc. If you structure the JD right, then tax is payable only on completion of the property, when the actual handover of property happens between the landowner and the developer. For here, there are few requirements to sort of take care. One is the JD should clearly say that possession is not handed over to the developer. Rather, the landowner is giving license to the developer to come and construct. Now, if the right to mortgage is given, it sort of defeats the purpose to some extent. If a power of attorney is given, that also will sort of defeat the purpose. Again, power of attorney can be given only to, there are multiple power of attorneys. One is I can give a GPA just to include everything, including sale. I've also seen special power of attorney or specific power of attorney just given for getting approvals for land, doing the construction activity, etc. In those sort of cases, it cannot be said that the possession or ownership has been handed over to the developer. Again, depending on the facts and how you sort of structure the JD, the tax would sort of get moved back and forth as the case may be. Again, there is this SSI Mills which I mentioned. There they have told that Supreme Court decision that it's a limited license, therefore tax won't come. And they're also in that decision silent about mortgage. Okay, I think I've covered most of it. And in case the tax is sort of deferred to a later date, taking 50D argument that guideline value I'll take may be a little difficult, as I mentioned earlier also. Only thing is, since I've deferred the taxable event to a later date, I also get indexation for that entire period. And value of construction or guideline value that of the land I'm giving up also will be as of the completion of the project date and not at the beginning. So many cases it may be, few cases what we have done assessment is, it may be better to sort of offer it to tax, assuming I'm getting this 50-day position of just offering guideline value to tax. Pay that tax today because there's nothing that has happened. If the tax is not coming to be a significant number, better pay that, offer it to tax, and then your construction cost may be much higher than the guideline value that you offered to tax, you may get away. So again, that assessment you can do depending on whether you want to defer the tax or pay the tax upfront, and whichever is beneficial, that option is always available to the landowner. Okay. If the JD, as I mentioned, is unregistered, then Section 53 of Transfer of Property Act is not applicable. Once it's not applicable, it is not transferred. And there's a Supreme Court decision that is there on this very specific aspect, which is Balbir Singh Maini. Again, as I mentioned, it works for smaller developments, doesn't work for larger developments. And again, looking at it from a TDS standpoint, TDS will be applicable on multiple facets. One is whether any TDS needs to be done on refundable deposit. Refundable deposit is like a loan or an advance which is going to come back, no TDS on it. Second aspect. Now, whether refundable, non-refundable deposit, whether it attracts TDS, answer is yes, because it's an indirect consideration of paying for the land, it will attract. Later, whenever there is a handover of possession, typically what happens is, I'll just talk about both commercial as well as a residential JD. Commercial JD, if it is area share, what happens is, at the completion of the project, the land, underlying land that is there will be conveyed from the landowner to the developer through effectively a sale deed, what they call an allocation agreement, to go and register. And the developer will convey the built-up area of that building to the landowner. This is what typically happens in case of area share commercial. Area share resi also, it can be very similar, where in resi what happens is, since I'm going to anyway sell, there will be no back and forth allocation or transfer of properties. Typically speaking, people will be okay with an allocation agreement and also this JD itself for making further sale. That way they avoid one layer of stamp duty between back and forth sale. So here, whenever that allocation is happening, there is a consideration effectively discharged to the landowner by the developer through construction service. So 1% TDS needs to be made on that particular thing. Just one question, somebody may be thinking, why not 10% TDS under 194 IC? 194 IC applies only for individual and HUF joint development agreement, not for non-individual HUF. Therefore, the rate remains at 1%. I think I've discussed all of it. Okay. So, key points for deliberation, just to sort of summarize. Date or year of transfer, depending on considering the uncertainty, construct of your JD, whether it's a license, handover of possession, all of it, that will determine. Full value of consideration, either it can be cost of construction or guideline value, whichever is higher. This is a more correct way, I would say, but 50D restricts it to guideline value of property that you're given up. Valuation, again, present versus future or current value versus future value. If I'm paying tax upfront, guideline value today is relevant. If I'm paying tax later, guideline value at the end of the period would be relevant. Impact of 50D we have discussed. Then implications of non-refundable deposit is higher than guideline value. Few cases what we have seen is the area share that the developer gives is less, but that is compensated by high amount of non-refundable deposit. So there I cannot take that guideline value is amount I'm going to pay tax because I'm getting more amount of non-refundable deposit upfront. So therefore that 50-day argument will be sort of failed to some extent. TDS we have discussed, IA and IC also we have discussed. Any doubts here, or can we move? Okay.
Scenario of higher amount of the non-refundable deposit given, the non-refundable deposit plus the 50D calculation will become the
Correct.
full value of consideration.
Yeah, Kumarpal, what there will happen very likely is you need to take the cost of construction plus the NRD that you got, add it up minus your proportionate land that you're transferring, that is the capital gain. It's a more stable argument, I would say, and again it may be favoring revenue. Depending on the appetite of the landowner, you can take a call. Okay.
Today's value or the value or
Today's value.
today's value. And in any of the instances where the JDA gets cancelled, say I have intent to pay and remitted the taxes, JDA gets cancelled, what would be the position of that?
So there is no concept of reversing after the revised return period is done. It's very tough. Transfer is done already.
For the cancellation of JDA, again there will be impact on the taxes.
Correct. So whatever tax you offered, that cost base at least will be stepped up. The land will come back to you. So logically speaking, you should get a step up in cost. Okay. It is like salary you offer to tax and employer is not paid. So So next point is, if it is JDA by individual HUF, what is the timing of taxation? So here, everything remains same in terms of example. If it is individual HUF, there is a specific section they have introduced, 45(5)(a). What that 45(5)(a) says is that tax is payable on completion or on obtaining completion certificate, either in part or full for the project. Meaning to say, if I have given a joint development, the construction is completed after 5 years, I need to pay tax only after 5 years. And if the development is done in phases, say phase 1 I'll complete in 5 years, phase 2 in 8 years, 10 years, etc. When I get my first occupancy or completion certificate, I need to pay tax at that point in time on my entire joint development. That's a position of the law. Quantification, etc. I'll come to, but this is the key difference between individual and non-individual type of landowner. And also other thing is, if I've done one JD covering phases, I need to pay tax at the earliest. However, if I've done survey number wise different joint developments agreement, like in phase wise, if I've registered different JDs, then the whole thing is, if RERA registration also is separate for each of that particular joint development, then I get to defer the tax in respect of each of that survey number effectively, or survey numbers, till the time that JD I get a completion certificate. That's the way it is. And again, it's a little funnily worded section which we'll see. Section 45(5)(a), the key thing is capital gains arising from capital asset being land and building shall be chargeable to tax in the year in which the certificate of completion is obtained. And more critically, the highlighted portion or the underlined portion is important, which says that landowner is required to pay tax on his share of land or building or both in the project as increased by any consideration received in cash. So one critical thing for 45(5)(a) to apply, you need to get your consideration in terms of area. If I'm getting the consideration only in terms of cash, this section is not applicable. So therefore, if you do a revenue share joint development agreement saying that 25% of the sale proceeds you give me, this section will not apply. So effectively, even if the landowner is individual, the taxation will be as we discussed for non-individual landowner. So that's the position that is there. Here again, as I mentioned, tax you get to defer it. But however, there is one critical aspect. What is the distinction here is my transfer getting deferred or is my tax payment getting deferred? Because transfer, there is no specific definition or exclusion saying what doesn't tantamount to transfer. All that it says in that section is, in case of transfer under a specified agreement, tax shall be payable when the completion certificate is received. The confusion that has been coming is, there is no separate transfer definition for 45(5)(a). So one view is that, which most of us subscribe to, when you do the JD, as we discussed earlier, whether you're given the possession, not given possession, all of it, that is the date or year of your transfer. Payment of tax gets deferred to a later date. However, because the transfer is getting triggered upfront, your asset classification, whether short-term, long-term, will be dependent on the year of or date of transfer. Your indexation, technically speaking, will stop on the year of transfer. It may lead to an absurd situation where I need to pay tax on guideline value of the property I get at the end of completion. However, my cost escalation has stopped at the beginning. But that's a problem which is section, the way it is worded, unfortunately. So that is one point that is there. One more is on the quantification, we'll see in the subsequent slide. And here again, if it is unregistered JD, this particular tax will not apply. Put it rather, whenever you get the possession, you need to pay tax on it. It's not a situation that upfront I was anyway liable to pay tax, which I could have deferred using an unregistered JD. And again, section clearly says that it should be specified agreement should be registered. So with that they've sort of covered that full section. Then again, if it is revenue sharing JD, this section will not apply where my entire consideration is coming in cash form, as we discussed. TDS obligation, earlier it was 1% because it was coming under 194 IA as transfer of land. Here they have introduced a specific section 194 IC where the tax TDS rate is rather 10%. Now the question that will come is, say year on year, like what would typically happen in case of a JD, assuming some part of it is also revenue share. The landowner may get payments from the developer, including non-refundable deposits, some portion of some other cash consideration, etc. TDS will start from year one. But whereas my transfer tax I need to pay rather is in year 4. What do I do with the TDS? Does it go waste, or do I claim it as a refund, or do I keep it aside and claim it in year 4? Refund. I'll have to claim it in year 4 because just the tax incidents didn't come, it doesn't mean that it's a refundable amount. So therefore you'll have to keep it aside. You'll neither get refund nor you'll be able to claim it against some other income of yours this year. Because the TDS chapter is fairly clear. If I'm offering income to tax, only then I can take the TDS. Otherwise I'll not be able to. Okay. Next confusion on this for individual HUF JD taxation is, as we discussed, the value of land or building or both in the project is liable to tax. Let me take the same example of 4060 JD. Now, what is the entitlement of the landowner? Is it 40% area? Correct, now in this 4060 JD, 40% area. Now the question is 40% area, does it include land or exclude land? Because the section, if you read it, it clearly says that share of the landowner being land or building or both in the project. Technically speaking, if you go by this, even the underlying land is included while quantifying the tax. Now it leads to an absurd situation if you go by this path or this particular view. What it effectively means is, normally speaking in a JD, what would have happened, my land of 40% would be with me as a landowner. All that I got is construction service from the developer against transfer of 60% of the land. If one were to interpret this that my entire 40% is taxable, which means that land which I never gave up also is going to be liable to tax. That's the absurdity of it, but the way the section is worded, that is what it looks like, or it is a high litigation risk, so to say. But logically looking at it, the view that with Sir and I both discussed is, it should not be that your own land you're taxing it at mark-to-market basis. That should not be. But in both scenarios, what ends up happening will be, if I'm sort of offering my entire area, including the land, to tax, my cost of 100% of the land should be treated as cost of acquisition. If, however, I pay tax or opt to pay tax only on the guideline value of the building, then I take 60% of my land as cost. It's logical, like both has to sort of match. Okay, any questions on this broad taxation of JD, timing, quantification, or any different view?
45 talks about land or building.
Or both.
Or both. What I am giving up is my land. What I am getting is the construction. Value of the construction on the date of possession should be the valuation.
So that is a logical interpretation. Wording wise, it looks a little absurd, because if you say his share being land or building or both in the project, then they should have simply told that whatever is a construction that I need to pay tax on. But they have written that it is being land or building or both. I'm not subscribing to the view that you need to offer it to tax. But if you look at it, everything that is written, everyone is sort of highlighting that this is a risk. Even to our clients, we highlight that this is a risk, because the way it is worded, it is ambiguous. And your luck is very bad, then this could be the position that you'll land up with. But also, put it differently, in commercial JD where you're retaining, you should not take this position. If it is residential JD, anyway, if you're going to sell, much rather go with this. At least you'll get a step up, or a lot of income will be classified as capital gain and less income as business income. So there also you can hair split. As an advisor, I can take different position depending on what is the end result required. So this is ambiguous enough to take either view.
And what happened in case if I started selling before OC?
That I'm covering next.
Okay. And also I wanted you to touch upon about the completion certificate. You did mention in case of a phase-wise development, first completion certificate. There is no concept of completion certificate in the state of Karnataka.
It will be OC.
But OC doesn't mean it's a completion. After OC, there would be a 30% more cost to be spent on the project.
Then the developer is getting OC premature.
No, sir. No. Need not to be. Because after OC, you will get the power connection for our information. Okay, and after OC only the common areas would be developed by the builder. After OC only I will started putting my tiles or maybe my sanitary fitting, depends on the customer choice. So there is something which we should have some common consensus about occupancy certificate and the completion certificate. So
Problem in Karnataka is, no, we have gone through this actually. Now, what other certificate will ever come in Karnataka? They have told that competent authority, whenever they issue the certificate that it's completed, that is what it is. Occupancy is that, my understanding of it under RERA, everything is, property is ready to be handed over to the customer for him to do balance whatever, and I continue to do my other bit of common area, all of it. Now, that is the only certificate that finally comes. No other certificate comes. Now, how can I impute some other certificate which is not going to come to defer the tax?
because by mere receipt of OC, the developer will not hand over the units to the landowners. There would be a little more work to be done.
No.
Like he said, he has taken the OC ahead of time.
So that even with just a concrete pouring, people have got OC, I am aware. So the point is, the understanding is that should be ready to hand over for doing interior. That's the understanding of this. He is anyway from developer, he'll tell.
I think once you have taken the OC, that means at least it is ready for occupation. You will not be able to take a position that it was, I got it otherwise. So I think that is what is prescribed. Now, in any case, this section 45(5) is a beneficial section they brought specifically for individual and HF, so that you are not having a difficulty of paying the tax on day one of the transaction, which was the field otherwise. That is why we have to, we have no choice. Now the only problem is, like they have said, part of the OC also, if you receive, then you have to pay the whole tax. Once you receive part of OC, you have to pay tax on the whole project.
But what is that your advice to the clients where there is a large development which goes about 100 acres?
Yeah.
Multiple
Then you
JDs.
don't
Multiple JD. Will that be a practically possible for a landowner to give a multiple JD based on the...
Why not? It is
Because stamp
possible.
duty is not going up anyway, you need to pay the same
It
3%
is
stamp
possible.
duty.
See, it is possible. What you have to do is, maybe one of the constraint generally is that your frontage of the land. Let us say generally the frontage is like a chicken neck.
Yeah.
Thereafter it opens. Now in that scenario, how do you do? So you have to have a easement right for each of the JDs. We ensure that easement right is protected. And also in each of the JD, you also ensure that the common amenities, what are going to come, all the, they will have a cross rights. And now under the RERA, one of the conditions that they have imposed that you cannot, say it is completed unless your basic amenities which are required for the habitation is already completed. So therefore, in any case, now OC is given after the, if you see the conditions for obtaining OC, all these, amenities need to be completed. So therefore, there is no, it will be difficult for us to say that it is not completed, I am not covered by 45 and I will defer to another day. That another day, like he said, there is no other document that will be there. That is the difficulty.
Okay, sir. Thank you.
Next point is, so far we discussed about JD tax where the land is held as capital asset. Next scenario would be where the land is held as stock in trade. Now, all this possession handover, transfer of property act, everything are applicable in the context of definition of a transfer under 247. 247 clearly says capital asset means for the purpose of capital gains, what is transfer is defined. A transfer in the context of capital asset includes, that is the thing they have written, like sale, exchange, all of it. Now the whole point is whether 53A can be applicable even in case of stock in trade, where I will say that tax has to be paid. So this has been a contentious issue where there have been case laws back and forth. Net, what it comes down to is whether the risk and reward of the project has it sort of been handed over from the landowner to the developer. That's one part of it. And also if you look at it from an accounting standpoint, when do you get to recognize the revenue? When there is no significant uncertainty of you getting the revenue as a business income classification, if that is a point in time I'll recognize the revenue. Now with this thing, like as a scenario I'll give, I've done a JD where the land is held as stock in trade. I've done everything. I've given right of possession, I've given power of attorney, I've also at the same time given right of mortgage of the property. Now in these sort of cases, whether tax is payable upfront even if the land is held as stock in trade. This is, there are both contra decisions for and against. There's a Bombay High Court decision which says that upfront I need to pay. However, there are Karnataka decisions which says that you don't need to pay upfront because effectively you're not transferred your effective right in the property because you don't have a receivable from the developer. So the position what we have been sort of working at is no need to pay tax in case of stock in trade till the time you get the property handed over to you. And you can also use this as a planning mechanism in the sense that if this property, if you're a non-individual JD, non-individual landowner, you want to enter into a joint development agreement and still defer the tax, you can always convert the land from capital asset to stock in trade and then do the joint development thereafter. And in case of 45(2), when I convert capital asset into stock in trade, unlike 28(6)(a), I don't need to pay tax upfront on conversion. If I do the reverse conversion, that is if I make stock in trade into capital asset, I need to pay tax in the year of conversion. Here, till this time that actual asset is onwards sold or transferred otherwise, I get to defer the tax. This is a standard planning mechanism that has been in place for many this thing. But only thing is conversion into stock in trade will work only if it is residential JD typically, or if it's a commercial JD where I intend to onward sell the property as a landowner. But if my objective is like in this 40/60 JD, I want the building to be constructed and I want to lease it and I am never going to sell for my life. Then the question is, can I continue to lease the property held as stock in trade forever? Not triggering tax, that becomes extremely contentious. And the whole problem is, tomorrow if they say that your inventory gets converted back into capital asset, I need to pay full tax including the underlying land value. So therefore, where you apply this planning mechanism, you need to be a little careful. Better if it's commercial property going to be retained for your own purpose, better not to go as stock in trade. Again, with Sir also we're debating, can I claim house property income if my classification of the property is stock in trade? There is no bar on it. Much rather, even on unsold units, Income Tax Act itself has sort of prescribed that it will be house property income, unsold flat inventory that is there. So therefore, the classification of income will not have a bearing. But the problem is, like one other case we were discussing, it's a company under Ind AS. They wanted to do JD and then wanted to sort of, land is already held as stock in trade there. Whole problem that came up was, once I sort of build up the building and lease it, under Ind AS terminology, you have stock in trade and then you have got fixed assets, then you have got investment property, something in between. And from a capital asset definition, if you see, anything other than stock in trade is capital asset. So the whole point that came out was that once I put it as investment property, most likely or very likely it will become conversion or deemed conversion into capital asset. Then I need to pay tax on guideline value of the property. Guideline value of the property will include the building at that point in time. And land to building, usually it may become even double in terms of value. So that's a risk that is there, and in that case we took a practical call to convert today back into from stock in trade into capital asset, pay tax whatever is payable, and then proceeded with the transaction. Now the problem is then we had to structure the JD that tax is not getting triggered upfront. Because one is I'll come from inventory to capital asset, and again if I'm paying tax it doesn't make sense. So that's a trade-off you need to take.
This is the Ind AS issue, but if it is a normal...
Similar, like how many years you'll hold it as stock in trade?
We can't claim depreciation also of the building.
Yeah, that I'll go under HP and close. 30% I'll get. Problem is like 2 years you'll keep, 3 years you'll keep, but if I'm keeping for 20 years, then your risk is kept on multiplying overall. Because the guideline value keeps going up. No? And all of it is business income. It will get taxed at highest rate. Okay, this I just discussed. Okay. Next is interplay between 45(5)(a). I think you have covered something similar, so I'll skip this. Yeah. So then one more case we put, say the individual is a landowner. What he is trying to do is he is trying to sell the land to a developer. Developer is going to do the sale deed of the land upfront. But in the sale deed, the consideration would be discharged by way of cash and 2 flats in the project. So that is the terminology. One transaction I'm working as we speak. Now the whole question here is, can I apply 45(5)(a) here, where I'm doing the sale deed right up front? Or can it still take this to be a transaction of development where while I have transferred the land upfront, can I still apply 45(5) and defer my tax? Now here if you look at it, if I've sold the land, it ends there. And I may have a right to get consideration after some time, which may be in kind. But from a capital gain tax standpoint and also stamp duty, the position that we are taking is, whatever cash consideration I'm getting plus guideline value of the property I'm getting, I need to pay stamp duty on that, on transfer of land. Likewise, capital gains also will be very similar. And only thing is, if I structure this transaction as a JD, will there be any GAR risk? A GAR, you don't know where it will end. Any tax, if you're smart, they say it's a GARable transaction. That being parked aside, if it's a sale deed you're done, it's very difficult or pretty much impossible to call it as a joint development for the purpose of tax. Okay. Next point which Vishnu sir brought up, I'm a landowner, I have entered into a JD. I have been allocated certain units today. Say JD I have entered in year 1, allocation of units also has happened in year 1. 45(5) applies everything, so I'm an individual, I get to defer my tax, all of it. Now only question is, the flat I'm going to get, will that be long term or short term? So now the whole question is, construction will be completed in year 4 and handover will happen to me on year 4. Can I take the position that my right in the flat came today, therefore the period of holding should start from today? Because it is right in property, the period of holding is 3 years. And unlike that earlier case of flat buyer, there is no conveyance that happens from the developer back to the landowner in case of a residential JD. This particular case, the whole discussion here is whether I can take long-term capital gain benefit on the entire thing in case of a landowner. Because here what is happening, if you recall, if you notice, land of 40% is continued to be held by the landowner. Only the superstructure, which is a flat, has come on top of it. Now can I take both to be long-term, or whether building will be short-term, land, underlying land will be long-term, or both will be short-term? These are the scenarios that are applicable. Now one way to sort of look at it is, whenever the allocation agreement happened, that's the position that one could take. Could be little litigative in my view, because what happens is the allocation agreement is done and the building itself, commencement itself has not happened. That also can happen in many cases. So before an asset came into existence, how can I say that my period of holding started? But however, as I mentioned, there is no conveyance happening in favor of the landowner from the developer. So therefore, it's a reasonable call to take that from the date of execution of JD, or allocation agreement, rather allocation agreement, not JD, because in JD there is no specific area given to me. From the date of allocation agreement you could take, and there are supporting decisions for this. And all of these decisions, all views we have put along with the decisions, and you can sort of refer.
One small tip as a practical measure, what you can do is, so far as the possession is concerned, you make the developer to give the possession directly to the purchaser. So in the sale deed you say that possession is given by the developer directly to the customer. In that way you can hold on to your argument that you got the right of this apartment on the date of allocation and it's a long-term asset and possession is directly handed over and you did not take the possession.
Yeah. But life will get complicated if you were a non-individual thing where tax is triggered upfront, then what happens, all of it. Those are permutations which you can sort of look at.
But by the virtue of sharing agreement, only right is there, but there is no building as such.
The point is, say, right after allocation agreement, 3 years has lapsed, and I'm selling or conveying my right along with the underlying land. So both are long term, then is it okay is a question. That's what sir was saying, that there's no possession taken over by the landowner, rather developer is conveying it. And as a confirming party, I need to come and sign. That would be the terms of the allocation agreement as well.
6 months of time, legal care says what?
Sorry?
Legal care. The legal care says the property. After it is, once it is conveyed to the landowner, it passes on to the
Gift we have put one case, we'll cover.
Okay.
So most of it, whatever we could think of, we have put. Yeah. So next portion is, this is individual, say landowner. Now that in that 45(5)(a) there is one proviso which says that any transfer of share of a landowner in the project prior to OC, the deferral of tax will not apply. That's the way it sort of reads. Now this could lead to 2-3 complications in terms of scenarios rather. One is I am a landowner, I have been allocated say 40 units. That 40 units one by one I'll keep selling. Now whether selling one by one unit out of my allocation, does that trigger 45(5), does that result in upfront tax coming and 45(5)(a) going off by triggering the proviso? Clear, this is one point. Second way is, say I've done a bulk sale or a wholesale sale where I've sold out of my 20 units, 18 units I've sold to an investor, he has taken and he has sort of gone. The second way, whether one by one sale versus 18 units sale out of 20, will that make any difference? Third scenario will be something like, with the consent of the land developer, I've gone and sold my underlying land itself. Say it'll be, I've seen transactions like this. I'm a landowner holding say 5 acres, I've done a JD with sir. I go and sell the land itself to a XYZ party, where after the sale, the JD will sort of continue because they've assigned the JD in his favor. That guy, whoever bought, will end up getting consideration from the developer over a period of time as and when the project gets completed. These are the two sort of scenarios where flats are sold one by one or in bulk. Second scenario is where the land itself is sold as a whole. And third one could be like, I have 20 units, over a period of time I have sold all 20, whether 45(5)(a) proviso will get triggered. This is the proviso that is there. Scenario where the landowner transfers his share in the project on or before the date of issue of certificate of completion. Capital gain shall be deemed to be income in the year in which such transfer takes place. Now the interpretation of it is a little tricky because 2 units if I sell, whether that is sale of share in the project or sale of share out of the share I'm expected to get. That's the interpretation, because if I'm getting 20, out of the 20 I'm collecting advance today, and I'm not doing a conveyance technically today because I don't have the right to convey. So here we put 3 scenarios. So key takeaway, at least in our considered view, is if I'm selling unit one by one, this proviso is not getting triggered. Even if I make a wholesale sale of all the units, this is not getting triggered, because in all those cases the sale is not happening today. It's more like I've collected advance. As and when I get my unit from the landowner, as and when I get the unit from the developer, I'm going to convey it. That's the position. So this proviso of 45(5)(a) should not get triggered. Then in that scenario, what happens is, whenever the occupancy certificate comes, the property is handed over effectively from the developer to the landowner. That bit I pay tax as capital gain up to that particular level. Onward, whatever I've sold, whatever was advanced till date, I'll consider it as sale consideration. Whether it becomes business income or capital gains, we put a separate case on that extra sale income that I'll get. That's a position to look at. However, if I sold the underlying land upfront, I'll simply apply 45 section. 45 section, what will end up happening is, I've got consideration for sale of land, I have the cost of my land. Whatever is a delta, I'll have to pay tax. Very simple. The only thing is, say under the JD I've got some non-refundable deposit on which I've technically not paid tax. If you ask me, that also should be added to full value of consideration, because otherwise I would have got more consideration for sale of my land, add it up and then offer it to tax and move on. That's it. So in simple terms, while there are so many scenarios, this could be the rule of thumb. Thing to add, sir? So many slides are there on that only. Yeah. Ma'am, this is inheritance and gift, where landowner has entered into developer JD with a developer. This is slide 72. Now, the landowner's entitlement could be gifted 2 ways. One is the units in what he's going to get could be gifted, or the land itself can be transferred. Now, if the land itself is transferred, it looks like proviso will apply. But the problem is, it is capital gain section and it uses the word transfer. Gift or inheritance is not transfer. Therefore, one can take a position that 45(5)(a) will not apply if I have gifted. And anyway, as we discussed, unit by unit, if you are selling or gifting, anyway, that is not a trigger event for the proviso. So in few of the cases, what we have dealt with, usually if the property is a commercial property, in residential property, what happens is it's a self-liquidating asset in the sense that nobody will hold the inventory for lease. Because if you hold house, residential apartment and lease, you'll get 3% return in terms of rental yield. So, and also the value will sort of go down over a period of time and not appreciate as much. So the whole point here is, in a residential JD, anyway, people will want to sell and sell as soon as possible. Because one developer was saying it's more like, inventory is like sweets in a sweet shop. We need to sell it quickly, otherwise it will become stale. That's the logic. Now say I'm looking at a reverse scenario where it's a commercial property where I don't want to sell. I'm a landowner, I want to collect rent over a period of time. At the same time, I don't want to pay capital gains either. This is a scenario that is there, which we have implemented these sort of structures. So here, what we have generally done is, a JD will be entered. Clearly in the joint development agreement, the terms will be that landowner is getting a limited license to come construct the building. I am not going to give any portion of my land to him. Land remains with me as is. He is going to put a superstructure. The understanding will be that whatever rent comes will come into an escrow arrangement. Superstructure he built, he will get 60% of the rent. I have leased land, I will get 40% of the rent. Clear? So land never got exchanged between the two, nor I got a building, nor the building owner got the land, or the developer didn't get land. Land remained wherever it is, superstructure came on it. And because it's a license to come construct, there is no handover of possession. Those scenarios are not applicable. Now in this particular case, one can comfortably take a position that land has never been conveyed. There's been no transfer of land. So therefore, whatever rent I get, I will offer it to tax and without any capital gains trigger. Now only shortfall or hitch with this is, you cannot take it as house property income, because house property will be in my hands. I am just a landowner. Taking house property income in this scenario becomes difficult. It invariably becomes business income. And also, given it is business income and land that I own, I'll also not get depreciation. Now it's a trade-off sort of thing, because if I pay tax, I'll get depreciation. But depreciation is, I need to pay full tax and save 25% depreciation on it over a period of time. It doesn't make sense to do it that way. And also where scenarios, in few cases, wherever it is SEZs, we have done something similar, where the landowner continues to keep the land, we just do the building and then get the rent.
Section 26. Sorry, on this point of treating this income as a property income, section 26, it says like this: property owned by co-owners. Yeah. Where property consisting of building or buildings and land appertaining thereto is owned by two or more persons and their respective shares are definite and ascertainable, such person shall not, in respect of property, be assessed as an AOP, but the share of each such person in the income from the property as a computed in accordance with section 20-25 shall be included in his total income. There is a case to say that when a two people own it, you can say 26 will also be covered.
Yeah.
Of course, the question is whether both of them own in each of them. Here we are bringing a point that land is owned by somebody, building is owned by somebody. But there can be a case.
Yes, sir. So that is like co-owner, like say we both own a property, you own 40, I own 60. So that will be split that way, vertical split it will become. But if it's where land is there separately, it may be a little difficult. Okay. Then one more question that keeps coming up is this section 80 IBA, which provides deduction in respect of development of affordable housing. The wording, if you see, is it says that who develops and builds an affordable housing project, that guy will get the deduction. Now the question here will be, say I am a landowner, I have given a JD to a developer, developer is doing the development. Now which of the two will get this deduction, or will both get the deduction? Developer getting deduction, very clear, because he's doing certain activity. Landowner doing deduction is a little tricky. And there is one Karnataka decision itself which says that, High Court decision, which you will get the deduction provided landowner also is expected to do certain development activity. So the whole point here is, while doing the JD itself, we need to carve out certain responsibilities for the landowner, that he needs to do this 1, 2, 3, 4, which look like development. Done, not done, that's a different thing. At least that way you have a decent position. At the same time, If it in reality it comes out that all the work is done by developer and landowner has not done anything, it becomes a little bit of a dicey sort of a situation. Okay. These are the summary. I'll not spend time on it. Broadly speaking, tax deferral for non-individual HUF will depend on license versus handover of possession. Once this fundamentally, if it is clear, and commercially if it is okay with the developer, you can structure it around where you can sort of defer it. Again, if it is a residential development, you can take a call to convert the property into stock in trade and then do the JD where you get to defer the tax. Apart from that, anything else, everything else we have covered here, and moreover that, as I mentioned, tax will depend on power of attorney, mortgage rights given, and also the possession that is required to be handed over ordinarily. Okay. Case of individual HUF, now one question that comes usually is, do I have the option to pay tax today? Because today guideline value is less, I'll offer it to tax, hell with it, and then I'll keep the property later. Unfortunately, it is not there. And if I make it into a revenue sharing, section 45(5) won't apply. Then I can pay technically tax today, but the problem is I'm not getting anything. Then I'm only getting revenue in future. That is also not a good scenario. That's a problem that is there. If at all you want to do this, you can contribute the land into a partnership form and then do, if you want to. Again, all the tax aspects need to be looked at. Again, few other aspects, license to construct we discussed. Percentage completion method, does that need to be applied even, okay, one more larger point which sir sort of briefly touched upon. I'm a developer, I'm following Ind AS. Ind AS 115 requires me to recognize income from construction contracts under completed contract method. Now, am I sort of forced to follow percentage completion method, or can I switch my tax payment also to completed contract method? Or which is basically deferring the tax to a later date. Is that feasible? Market, we have generally sort of looked at multiple listed companies. Most of them have made the switch to completed contract method, because POCM guidance note is nothing but an AS7 which has been lifted and put there. The whole point here is tax should follow accounting unless there is something explicitly against it. That's the position with a lot of case laws that are there, Chillapalli sugar mills and all. There the whole point is they're taking that today my income recognition standard itself has changed, therefore tax has to follow. And for few of them, developers, what happens is some old project is there which is under POCM, new project will come under completed contract. Can I have a mix match of it? So these are the practical aspects that come, but in general people have sort of transitioned to, up north many of them, to completed contract method in line with accounting. So another thing is, if I'm a landowner, I've given my project under JD, what sir was also mentioning. Now, can I take my entire income to be capital gain? Or whether some partial portion becomes business income, all that long-term, short-term, all of it that we discussed. So 45(5), how you interpret that, those things are fine. Net-net, the key takeaway here is for land transfer related thing, that will be capital gain. Anything over and above you make, very likely depending on what call you take on allocation agreement, could become short term. Once it becomes short term, then anyway whether it's business or short term doesn't make any difference. But if you structure it right and time it right, you will get long term capital gain benefit for the entirety, as long as you're able to push the upfront tax to a later date. Again, plotted development, sir also had covered one solitary development, where agricultural land has been cut into plots and subsequently sold. They should be taxed as capital gain. Few cases wherever these things are there, it's better to do a joint development equivalent, where the developer will come and say that I'll do the construction, whatever development of the road, infra, etc. and I simply sell the plot. That way at least it's much easier or safer. Or other way is to simply convert it into stock in trade and then do the JD. Okay. Next is, what time is it? 5 minutes, I'll close. I don't know. FEMA I'll take up. Partnership tax, whatever were the interesting points, everything has been sort of buried actually with this Supreme Court decision in Mansukh dying, where revaluation they have held that it is taxable in the hands of the firm because it tantamounts to transfer. But it to figure why or how it is a transfer. Lot of material, not lot of, all the material we have shared, and you can sort of look at it. So broadly in terms of FDI policy, quickly I'll cover in 5-10 minutes. So under FDI, earlier there used to be a lot of restrictions like how much should be the area requirement for getting FDI, all of it. Now most of it has been liberalized. All that now it says is that if I'm getting a foreign investment into construction development, what we call as a greenfield project, that is permissible. There's no minimum area threshold, nothing that is applicable. All that I need to do is, if I put the money, I need to develop that particular project. After the project is developed, I can exit. That's the current framework as things stand. And also they are given a leeway because many cases there were stuck projects. Because I put the money, nothing has happened. How much long can you sort of hold me? And also from a government standpoint, real estate is a little sensitive topic. There they don't want this hot money coming in and sort of moving out quickly. So the whole idea here is, if I'm putting money, there has to be a lock-in of 3 years in general, or you complete the project and exit, whichever of the two, whichever is earlier, that is good enough. That's a broad framework that is there. What is not permitted or prohibited is essentially trading in land. I buy the land, I hold for appreciation and then sell as is. That's not permissible, because similarly anything to do with transferable development right, that also is not permitted. So what is permitted, put it differently, is any construction of any sort of property is permissible other than this farmhouse. Because farmers, a lot of NRIs were sort of abusing that particular thing, so that bit they have blocked. But for that, that is a structure as we speak. We'll get into final nuances in 2-3 minutes time. And another thing is, for ODI regulations, again, real estate activity is restricted because the whole idea is we're not letting others to come and do some nonsense in real estate. Likewise, reverse also you can't do. In ODI, the whole point is, if I'm undertaking development, only that is permitted. If I simply want to buy and lease, that is not permitted under ODI. Now, the way people have been doing is to structure it as a hospitality type of an investment, service department, or if it's an office space, it can become a co-working space, which takes a color of a business than becoming more like a property on which I'm getting a rental yield. So that's the structuring that is in vogue today in respect of foreign investment. Just moving on, just one more point I wanted to bring about is leasing of property is no longer regarded as real estate business. In 2015 that changed, because historically what used to happen is, I'm a MNC company in India subsidiary. I bought a building for my purpose. Then there are 3 floors empty vacant which I need in future. The way the law stood at that point in time is I couldn't even lease the surplus space that is there in a building that I own. Later they liberalized a policy saying that I can lease the space to my group company so long as it doesn't exceed a particular percentage of my turnover. Finally they told leasing is fine. Now the whole question that comes is, can I simply buy and lease? That bit I'm going to cover later. On this construction development, broadly as I discussed, it's a 3-year lock-in that is there, subject to which the sale can happen. Everything else is linked to normal FEMA in terms of pricing of entry, exit, everything. And because there is a 3-year lock-in, I am not allowed to do real estate business, get FDI into an LLP engaged in real estate business, because this is a performance linked condition. That's the whole this thing. And also while 3-year lock-in is there, that is more for the investment being sold one level above, but undeveloped plots cannot be sold without having been completed. So that's the position. And again, you have this concept of business center. Any commercial property will qualify as business center. If it's a commercial property yielding rent, I can buy it under FDI, no restrictions whatsoever. It can be brownfield project completed, no problem, because it qualifies as a business center. Only thing is, you are locked in for a period of 3 years. If I invest in a business center, I'm locked in for 3 years. If any other sort of things, I'll look at it, I'll walk you through later. There's no lock-in. And this also means that since completed property, if I'm buying and leasing only since it's permitted in business center, I cannot do rental housing. Rental housing, I mean, is I am an FDI investor, I cannot buy 100 flats and lease it to anybody. That's not permissible under FEMA or FDI policy, but for that pretty much everything is good. And again here, in what scenarios lock-in is not applicable? Anything to do with hospitality, then hospitals, special economic zone, industrial parks, lock-in is not applicable. Likewise, even for NRIs, it's not applicable. So again, I've put industrial park, all of it, so I covered broadly what was required. Now again, the question keeps coming is whether co-working, how is it permissible? Co-working, co-living. Whole point is I'm not bought a property there. Effectively, it is more like a business activity I'm running, which is more like a hospitality. Typically, it's a leasing in, leasing out, and as I mentioned, leasing per se is services. And if I buy residential house property and just lease, that is not permissible because it is not business center. But if I buy residential property and run a co-living facility, that takes a color of hospitality. FDI should be permissible. Okay, I think I've covered. Put one summary. So overall, all sectors, whatever you could think of, we have sort of captured it. So with this, we'll conclude my session. Thank you.
Thank you, sir. Thank you, Vishnu, sir, and thank you, Amith Raj, sir. May I call upon... who's the call? Vinay, sir. May I call upon Vinay to please hand over a memento to Mr. Amith Raj. Thank you. Joe.